Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hey, podcast listeners. Today we're doing something a little different. As the year winds down, it's always nice to reflect. And so today we're going to be publishing an amalgamation, a group of some of our top rated and downloaded podcasts of the year. Enjoy today's podcast mashup. Hey, podcast listeners, we got another great show for you today. Our guest is a legend of the resource investing space, where he specializes in mining, energy, water utilities, forest products, and agriculture. He has originated and participated in hundreds of debt and equity transactions with private and public companies with decades of investing experience. He is the founder of Global Resource Investments, president and CEO of Sprott U.S. Holdings, and a member of the Sprott Inc. Board of Directors. In today's episode, we discuss natural resource investing and the outlook for precious metals. We cover some of the macro factors that have influenced prices historically and the case for why metals appear attractive in today's environment. Make sure you stay tuned to hear some of the thoughts about the best practices in portfolio implementation and what to think about when getting involved in this asset class. Do not miss, make sure you listen to the end, where our guest makes the incredible offer to review your own personal natural resource portfolio, make some comments, and even rate your holdings, all for free. Please enjoy this episode with Rick Rule. Rick Rule, welcome to the show.
A pleasure. Thank you for having me, sir.
I'm so excited and honored to have you here as a guest in the beginning of 2020, dawn of a new decade, which is great. And I've known you for a while, and you started your career in a similar way that I started mine, but in a different world. We both started during a romping bull market. In my case, it was in biotech stocks and internet stocks in the 90s in the US. In your case, is a little different world, natural resources. You want to give us a window into your beginnings?
Sure. I started in the early part of the decade of the 70s, which was, of course, a decade that was probably the easiest era in modern history to be a natural resource investor. Over the course of that decade, the gold price went from an admittedly price-controlled $35 an ounce to $850 an ounce. The copper price went from about 25 or 30 cents a pound to $1.50 a pound. The oil price went from $3 to $30. It was truly an amazing time to be in the natural resource-based businesses. And it was during that period of time that I learned, unfortunately, two important lessons. The first is that markets work. And the boom of the 1970s gave way to an epic bust in the 1980s. And I learned all about cyclicality. The second lesson I learned is one that unfortunately many young men have to learn, and that's not to confuse a bull market with brains. By the end of the 1970s, I sort of thought I was God's gift to investing. And when the commodity prices fell in the early part of the decade of the 80s, I learned that that wasn't the case. But it was an interesting way to start one's career.
It's so funny how history rhymes. Listening to you describe this could just substitute out the industries and time is, my exact same experience, where really coming of age investing during the internet and biotech bubble, thought I was the best trader on the planet, the next George Soros. Fast forward a year or two, I'm eating mustard sandwiches for a year because I imploded all my money, investing all these. For many of us, and I think it's probably the best lesson to learn, certainly when you're young and don't have a lot of money, because you never want to go through that again. Man, physically painful. All right, so we haven't done a whole lot on natural resources on this podcast. So why don't you give us a lay of the land? You've been through some various cycles. As we turn the page on 2019 into 2020, what's the world look like today? It's been a bit of a fallow period for a lot of parts of this sector over the past number of years.
I think it's important to note, first of all, that there isn't necessarily a common theme across natural resources investments. The market, if you will, really consists of a whole bunch of different markets, some of which are related. But I think it's a mistake to expect them necessarily to move broadly in tandem. That said, I think for reasons that we can discuss later in the interview, that the wind is in the sails of precious metals investing, both with regards to the metals, which of course performed fairly well last year, and the equities. I would suggest that the broader outlook for natural resources is mixed, attractive in the sense that many commodities are priced below the total cost of production, if your definition of the total cost of production includes the cost of capital for the producer, which I believe it should. And that's, of course, bullish. But the second factor is, and I'm not an economist for sure, we've been 10 years in an economic recovery. And my own experience in investing tells me that an economic recovery that's gone on for 10 years is probably long of tooth, particularly if you believe that some portion of the reason for the recovery has to do with unusually generous, some would say artificial credit conditions. So I think in a very broad sense, the outlook for resources this decade is certainly better than last decade. For precious metals in particular, I think the outlook in 2020, 2021 is probably very, very strong. For the rest of the resource-based businesses, I think investing in them depends on the commodity and also on the individual investor or advisor's own economic outlook.
The nice thing about listening to Rick over the years, listeners, is that when you talk to a lot of people on whatever their investment strategy or asset class is you may have a gold bug who's always bullish on gold, or the guy who loves U.S. stocks no matter what, but you don't necessarily have that. Having known you for a long time, it's refreshing to hear a little more nuanced view. So we'll stick on precious metals here for a little bit. It seems one of the big macro influences that has driven gold in the past is where interest rates are relative to inflation, so what we'd call real interest rates. And this has certainly been a surprise, I think, to a lot of investors and economists over this past cycle, where you have a large fraction of the world that has negative yielding sovereigns. Maybe talk to us a little bit about how that may have any effect or none, or play into what's going on with the attractiveness of gold and silver.
Well, I think you nailed at least half of the precious metals theme. As we speak today, of course, the 8th of January, gold has had a little bit of a move on geopolitical events. At least that has gotten the credit for gold's move. My own experience teaches me that price recoveries in precious metals that are due to geopolitical events are very, very, very short-lived. In truth, in my career, the most important determinant in precious metals prices has been global investors' faith or lack of faith in fiat currencies and in sovereign debt, particularly U.S. dollars and U.S. dollar-denominated debt. And I would suggest that the current strength in the U.S. dollar is more due to the weakness of its competitors than a real fundamental strength in the U.S. economy. Certainly, if you think about the avoided cost of owning precious metals, that is the yield that you get by parking money in savings instruments, particularly gilts, sovereign credits, 7 or 8 years ago, that was a real concern to a gold holder. These days, depending on the currency that you're holding the sovereign debt in, with negative real or negative nominal interest rates, that concern goes away. My friend Jim Grant describes sovereign debt as return-free risk and calls gold the good, honest zero. So in the sense that sovereign debt doesn't provide the yield that it once did, and also the related case that the avoided cost of owning gold goes away, gold becomes more attractive. But the other concern is less a concern with yield than it is with credit quality. We tend to neglect in the United States that our on-balance sheet liabilities at the federal level exceed $22 trillion. The net number, of course, is less, only $16 trillion. And the off-balance sheet liabilities, I'm 66, so things like me, Social Security, Medicare, those numbers, according to the Congressional Budget Office, are about $100 trillion. So if you look just at the federal level, not at the state level or the local level, you're talking about $120 trillion in recourse liabilities. We're servicing this debt with the national income, taxes and fees, less expenses. The problem is that the income stream is -2, to the tune this year of about $1.4 trillion. US dollar investors are beginning to become concerned about the probability of adding a column of negative numbers, that is, budget deficits, and coming up with a positive sum to satisfy that debt. And I think that that is really one of the reasons why precious metals are beginning to do well, a lack of viable alternatives. Of course, there is fear, too, among investors. Fear that the recovery that we are in the midst of is one that's driven by liquidity rather than solvency. Experience teaches me that liquidity and solvency are very, very different words. And finally, I think one factor with regards to both precious metals and precious metals equities is that precious metals and precious metals equities as a class are alleged to comprise about 0.5% of the savings and investment matrix of private parties in the United States. That is, their market share is less than 0.5% of total savings and investment assets. The market share of these same instruments in 1991 approached 8%. And the 3-decade mean has been between 1.5% and 2%. So if we take the view that given concerns about the U.S. economy, and in particular the balance sheet and the income statement of our government, and combine that with low interest rates, I'm not suggesting that the market share of precious metals and precious metals related assets would approach its 1981 high. I'm just suggesting that a reversion to mean is not unlikely. And were a reversion to mean to occur, then demand for precious metals and precious metals equities would increase by 3 or 4-fold, which is, it's an interesting possibility that I actually believe is a probability.
As you look back in history, I mean, this kind of environment we've been in of low inflation, low interest rates, like you mentioned, it's odd to see the U.S. is actually one of the higher yielding sovereigns out there. If you look at all the countries with similar interest rates, it's almost universally emerging markets. But contrast that when you were cutting your teeth, recently passed away, Fed Chairman Volcker, trying to tame inflation and interest rates in the double digits. You have a whole generation of younger people who've really never experienced inflation, certainly rising or even higher inflation that's even moderate. And it'll be interesting to see how sort of that demographic starts to think about this. One of the questions I wanted to ask you, you probably have more lines in the water of sentiment of what's going on, and precious metals, we'll keep the focus there for now, more than anything tends to be a market where you go through these periods of desperation as well as mania on the other end. And so 2 parts to this question. One is, where do you feel the finger on sentiment, but also with regards to demographics, because when I think of gold, I traditionally think of the older generation who maybe experienced these inflationary times and understood the role that gold may have played, and even their parents' generation back when we used to have a gold standard, et cetera. How do you feel the younger generation, whether it's the millennials, Gen whatever, the 20, the 30-year-olds, even 40-year-olds, do they have a different view on that than maybe an older cadre, or is it more nuanced than that? So 2 parts. What's the sentiment like? And then is there a difference in the way people view it based on their age?
I'll give you 3 answers to that. The sentiment around what I laughingly call the hard money constituency is pretty bullish. Now, in fairness, the recovery in gold prices has helped. And asking gold bugs whether or not they believe in gold is sort of like asking an evangelical congregation in church whether they believe in God. They tend to be, except at the very worst of times, a pretty loyal following. What has been interesting for Sprott in the last year and a half is the amount of interest that we have generated, and frankly, the amount of money that we have raised from generalist institutional investors, both in the United States and abroad. University endowments, pension funds, the idea that precious metals in particular and precious metals equities are an important part and an oversold part of a balanced portfolio is something that we worked 5 or 6 years in getting across to institutional clients. And beginning about 18 months ago, we began to make very substantial inroads. So at least among institutional investors, both in the United States and in other parts of the world, there is a real newfound interest in precious metals, I think as a consequence of their nervousness about other asset classes that they think are overbought or in some other way risky. The final part of your question, of course, has to do with broad popular interest in precious metals and in the demographics that are interested in precious metals. We here at Sprott U.S. Holdings looked at the inbound retail inquiries that we got in the final 3 months of 2019. Approximately 2,000 people contacted us, which is an interesting statistic in and of itself. Interest was high. What we found was very interesting. One thing that we found was that 40% of the people who contacted Sprott were outside the US, and for that matter, mostly outside Canada. The second thing we found, and I think this is a consequence of doing interviews like this, which are posted online, is that about 65% of the respondees were what most investment advisors would classify as younger investors, which is to say sub 40. The joke about the gold investor is that the investment class is dying literally, meaning that they are people who came into the sector already having some money in the 1970s. But this new demographic is very much younger, under 40. The most interesting thing for me personally is that more than 30% of the inquiries that we fielded were female. We have traditionally not seen women interested in any investment class in the 40 years that I've been in the investment business, and certainly not seen female investors interested in natural resources and precious metals. So the fact that there is broad spread interest, particularly in precious metals, rather than broadly dispersed across resource-based businesses, that a lot of this interest is global, that is to say, non-US, that 2/3 are what would classically be classified as younger investors, and that 1/3 is female, suggests that interest in precious metals is broadening in demographics that we haven't seen interested in precious metals, at least as a U.S. investment provider, ever.
That's fascinating. I wonder how much, and just spitballing here, I wonder how much of that Venn diagram of the younger cohort, in particular female, which traditionally in finance in general, I mean, I think our podcast is like 90% male. Same with my Twitter, which is so sad and depressing. But how much of that Venn diagram, I wonder if that interest is sparked or generated by the crossover of interest in the cryptocurrency digital asset wave. Do you think there's some correlation there or totally unrelated?
No, I think there is some correlation. I think the crypto narrative had a lot to do with questioning the fiat narrative. And I think that a lot of younger investors and speculators got interested in the concept of currencies as mediums of exchange and stores of value, and came to understand that precious metals probably fulfilled that role in some ways better than crypto, in the sense that crypto is like fiat, a promise to pay, whereas at least physical precious metals represent payment in and of themselves. The second thing that is of interest to me and would have made sense, or does make sense, but I hadn't thought about before, is that in terms of the younger female audience, the easiest subset of that to identify is South Asian females, Pakistani, Indian, Bengali, or Sri Lankan, commonly employed in the technology business. Young women with a cultural predisposition to precious metals as a consequence of their South Asian upbringing, a highly educated group of young women with great access to information. I've interviewed several of these young women. Since I didn't know how I reached them, I was interested in reaching more of them. And I heard a similar story. Women in their 20s with technical degrees in things like engineering or programming, very high income, between $150,000 and $250,000 a year, with a cultural predilection to save. Certainly, there is a broader interest among young women in precious metals too. But this South Asian cohort was something that I had not seen before and something which interests me personally.
That's great insight. As before we hop on over to the equity side of the business, are there any other commodities that you pay particular attention to? I've heard you talk about just about everyone in the past. I'll let you take your pick, 1, 2, 3, as many as you want to talk about, but whether it's oil, platinum, palladium, copper, anything, uranium, anything else on your mind or that you think is particularly interesting or scary, exciting, beginning of 2020?
Well, let me talk thematically. I like places that other people are bored with, or preferably that other people hate. So I'm naturally drawn as a consequence of that to the uranium market for reasons that we'll talk about. I'm not suggesting, pardon the pun, uranium is going to explode anytime soon, but it's certainly a commodity that brings out the contrarian in me because people hate it. They're not merely bored by it. I have also made a lot of money over the last 30 years in the water business. It's a very, very, very boring business, and it's very difficult to invest in. Taking liberty with one more bad pun, the problem with the water market is that it's illiquid, but it is a sector that has served me well. Finally, I am in the process right now of beginning to divest of a portfolio of passive investments in very high quality multifamily housing, investments that I made about 30 years ago. And I'm placing the money that I'm recovering from those investments in passive investments in very, very high quality agricultural land in the upper Midwest of the United States. So those are areas that attract me. Thematically, what I tend to look for is a commodity that is necessary to sustain the lifestyle that we live and sort of for humanity, so that ongoing demand is fairly assured for it, but a commodity that is depressed enough in price that the selling price globally is less than the industry average cost of production. That is to say, an industry that is in the process of liquidation, where mankind cannot afford to see it liquidated. Because natural resource businesses are so capital intensive and so cyclical, markets work in predictable, albeit delayed, fashion. And so you can have a circumstance where a commodity that is absolutely necessary to the way we live is priced below the cost of production. When that occurs, there are only two possible outcomes. Either the price goes up or the commodity becomes unavailable. So as an example, 2.5 or 3 years ago, the price of oil was about $40 per barrel. Now, the International Energy Agency, who I suspect gets it close, nobody gets it right, suggests that the fully loaded cost to produce a barrel of oil is about $60 per barrel. It's been coming down with low interest rates and the technological advances, particularly here in the United States. But at $40 a barrel, that means that the industry worldwide was losing about $20 a barrel and doing it 100 million times a day, which is to say losing between $1.5 billion and $2 billion a day. That becomes fairly boring. And at some point in time, sustaining capital investments aren't made, new investments aren't made because the industry is losing enough producing what it doesn't want to grow their losses. And in that circumstance, your thought as an investor has to be like this. Do I believe that 5 years from now, when I go to my garage and turn the key to the right, the car starts? Because if the answer to that is yes, then you believe that the price of oil is going to go up. Naysayers, of course, would say, well, what about if you have an electric car? And I would only point out that the electric vehicle share of the gross vehicular market worldwide is fairly insignificant. So I look for commodities that are necessary to the way we live, where the selling price of the commodity is less than the cost of production. That leaves me with an investing scenario where the question that I ask myself is, when does it recover? It's not an if question, it's a when question. And I love those. I believe myself uranium is a when question. I can't answer the when question, but I believe that you have a commodity there where the global cost of production is above $50 a pound, probably closer to 60, and where the product sells, at least in the spot market, for $27 a pound. Although we all love to hate uranium, we all like the lights to go on. And uranium, even in rich markets, or supposedly rich markets like the United States, which could afford alternatives, still rely on nuclear power for 15% of our baseload nationwide. If you believe that in the United States 5 years from now or 6 years from now, when you hit the switch that the lights are going to go on, you believe in higher uranium prices. It's really that simple. Is it going to happen in 2020? I don't know. I'm not sure. But I've learned to love asking myself questions where the answer begins with when, not if.
Yeah, you touched on a lot there. I was laughing in the beginning because we have some farmland in western Kansas, and it's been somewhat of when you talked about, I forget the way you said it earlier, but return-free risk. The prices of wheat and corn and everything else haven't been so low the last few years. It's like investing in treasuries with a lot more headache. But
that's precisely why I like it.
Yeah. Well, I got the contrarian bent too. And so we've done some quant studies over the years that look at asset classes and industries, particularly when they're down 60, 80, 90%. And also sort of fun. Another way to look at it is down multiple years in a row. And rarely do you have the big asset classes, we're talking US stocks or bonds, that go down more than 2 or 3 years in a row. But in the industries and commodities, you certainly can have a really long stretch. And so today, that's a lot of the ag space. But over the past handful of years, we did an article where a few years ago was asking for coal in your Christmas stocking, coal stocks, because they had been down multiple years in a row. And uranium stocks continue. The difference between, of course, they're related, but the price and uranium stocks continue to hit lows. Certainly on the timing side, we could channel our buddy Steve Sugarroot and say, wait till it enters an uptrend as a good place to be. But man, a lot of those places are totally bombed out, some down 80, 90%, but certainly some interesting spots. That may be a good segue to talking a little bit about the difference in the commodities themselves and the prices and the natural resource companies. And you guys do a lot. You've been doing this a long time. And if there was a single area of the market that I would probably be, as a newbie, the least inclined to get involved with because of the hurdle of knowledge, but also so many, I think, beginner mistakes, it would be the natural resource market. Talk to us a little bit about your approach and the right approach to investing in natural resource companies, some of the common mistakes that both retail and institutions make, and any general thoughts there?
The first thing to understand about resource businesses is the idea that I led off with, which is that they're cyclical and capital intensive. I ask people, if they're considering natural resources, to always remember and attempt to employ the phrase that in resources, you are either a contrarian or you are going to be a victim. These things get way, way, way oversold because they're so capital intensive. If you have $3 billion invested in a copper mine and the copper price goes from $3.50 to $3 a pound, you still sell it because you need to generate cash. If it goes to $2.50 a pound, you sell it anyway because you need to generate cash. If it goes to $1.50 a pound, you keep trying to sell copper to win the last man standing contest, to stay open when your competitors have to close so that you participate in the rebound. So these things become way, way, way oversold. And ironically, on an industry basis, when EB to enterprise value appears to be at its worst, that is, when the industry as a whole is selling at a very high multiple to cash flow, it's happening because cash flows are constrained. So rather than pay attention as a normal value investor would to enterprise value to EBIT, what you have to pay attention to is the cost structure of the company within the industry, and then the industry's cost structure relative to the selling price of the commodity. Conversely, when the commodity markets recover, the prices go much higher than you would expect in a normal business because the business is so capital intensive and because the permitting and exploration lead times are so long that the market doesn't respond as efficiently to pricing signals as it does in other businesses. As an example, if the market clearing price in oil is at $60 a barrel, but the oil industry has underinvested in sustaining capital investments for 2 or 3 years, the price of oil can easily go through 60 to 75 or 80 before correcting. At that point in time, industry cash flows are gigantic, and the EBIT enterprise values can be extremely low. When the industry feels cheap from a quantitative point of view, it's often very expensive from a qualitative point of view, and vice versa. The second thing I would say is that participating in the business, I suspect, like any other class of securities, becomes substantially more nuanced the smaller the market capitalization. Both the risks and the reward get much, much greater as you come down market. And in addition, like other industries, the distribution of information becomes much less efficient. If you care about resource businesses and you're focused, as an example, say on Barrick in the gold space, or BHP in the mining space, or Exxon in the oil and gas space, there are probably 50 or 60 sell-side analysts that have reasonable access to information and are incented to distribute that information. But if you come in the sub-billion dollar market cap space, ironically, particularly for solvent companies that won't have to raise money and pay fees to investment banks, the research coverage and research distribution, particularly on the sell side, is often non-existent. And where it does exist, often exists as, if you will, cheerleaders for investment banks rather than as independent sources of information.
So if someone's interested in getting involved in an allocation in a natural resource equity world, what's your general advice to them? Is it something you say, look, you either got to be a total expert or hire one or just index it? Do you say stick to the majors or say, hey, here's some ideas to follow and just go all in? Because I know a lot of people that initially get attracted to the sector get attracted because they want to speculate and find the next exploration company that's going to do 100-bagger. Having been involved in thousands, tens of thousands of investors over the years, what's the general advice and specific?
I think most investors who want to have a life, that is, not devote substantial amounts of their time and energy to the resource space, should probably construct a portfolio of 10 or 12 or so of the largest and best integrated natural resource businesses in the world and stop. I think that they should probably, if they are disciplined enough, focus on out-of-favor sectors or at least overweight out-of-favor sectors. The idea, as an example, that you would do yourself a timing favor by buying Chevron or Exxon during a period of time when geopolitical tensions are threatening to shut the Straits of Hormuz, probably not a good technique. Conversely, points a time when The Economist magazine forecasts the end of the oil business. That's probably a very good time to do it. I'm becoming, for those investors, less enamored of ETFs too. Although the ETF is a one-size-fits-all vehicle that allows you to capture market beta because it is market beta, too often the ETFs are conglomerations of good and bad companies. And my suspicion is that a judicious investor, rather than paying for someone to construct a 40-company index that almost by definition has 25 lousy companies in it, that investor who sought to buy the 4 or 5 best companies in the sector and simply hold them for 5 or 6 years, or until that sector had returned to favor, my suspicion is that most investors would be better off doing that. I am not suggesting that your listeners don't speculate. All of the money that I now use to invest prudently, I got by speculating, in some cases wildly. It's just that when you speculate, in addition to using your treasure, that is your capital, you have to use your time. And for many speculators who get caught up in the natural resources and particularly the precious metals narrative, the adherence to the narrative becomes so strong that those same investors don't spend as much time understanding individual issues and the nuances of the companies that they're invested in as they should.
You touched on something I think is important. We talk a lot about here that I think is a major dislocation, not just in natural resources, but in almost all of investing, where you have so many people that are attracted to an investment and they say they have a long time horizon. And in reality, it's like weeks and quarters. I mean, maybe 12 months. So you mentioned 5 to 6 years. And I think that is a really hard, even for professionals. I mean, we've seen study after study after study that institutions consistently totally get this backwards too, where they fire the guys with the worst 3-year track record and hire the guys with the best, and it should have just stuck with them. Talk to me a little bit about how any insights into tips, hacks, suggestions for holding period, and then also under that same umbrella, how to think about it in terms of a portfolio. So let's say you have the blessing of a stock that goes boom, it doubles, it triples, it's a 5x, it's a 10x that now is most of your portfolio. What do you do about it, or most of your natural resource allocation? How do you kind of think about the actual practical implementation once you have a portfolio?
You've asked a lot of questions there.
It's the number one worst thing to do as an interviewer, but it follows my train of thought in general conversations, which is to mash a bunch in together. But the simple question is, practically, what sort of advice can you give on real world implementation of putting this together?
Implementation is always a challenge. Mike Tyson famously said everybody had a plan until he hit him in the face. And I think that happens to speculators and investors. They make a plan, their life or circumstances change, they forget why they made the plan, and they alter the plan. As to time horizons, most investors have a time preference that's unrealistic. As a speculator, as an example, speculators make their money by trying to predict the outcome of unanswered questions, answering and understanding the outcome of unanswered questions. In technology, that might be, is this microbe efficacious for this biotechnology use? In software, it might be, will this algorithm solve a problem? In exploration, it might be, does that surface expression turn into a copper or a gold ore body? But the point is that making money in speculation really involves answering some unanswered question. And in order to make the speculation intelligently, you have to have some sense of A, the probability of a yes answer, but B, the length of time that will be required to get that yes answer. Most speculators don't do it that way. Most speculators have a theorem that I'm afraid goes, got a hunch, bet a bunch. And the consequence of that is that their time preference becomes their time spectrum, which is very, very unfortunate. It's ironic that at age 66, while I now have less time on Earth than I had when I was younger, I always think in 4 or 5 or 6 year terms. We discussed earlier in this interview the fact that I'm exiting some passive investments in multifamily residential. Those investments were made in 90 and 91 and 92. And I suspect that the investments that I'm making now in grain and bean land in the upper Midwest will be investments that I will hold for at least 10 years. So let me say that in terms of time preference. I think it's important when an investor makes an investment, or for that matter, a speculation, that they be honest with themselves and probably write down the reasons why they strapped on the position, what their goals are for that position, what the unanswered question is if they're speculators, what will cause them to sell the stock, basic business plan, if you will. In my life, in speculation, always tried to ask myself, what's the unanswered question? What will cause the value of this company to increase and hence, hopefully, the stock price to rise? What will be my estimate, my approximate estimate, because you'll never get it right, as to what the market response to a yes question will be? What are my 3 biggest risks? And what should I be looking for signs that those risks are manifesting themselves in the investment? And at what point in time will I declare that investment a success and sell it and ride on? Sometimes, frankly, in natural resources bull markets, particularly when people are interested in exploration stocks, I might buy a stock for $1 based on the expected outcome of some exploration proposal. And the market will be excited enough about the potential of the exploration that the stock will get bid to the price that I thought it might get after a successful effort. In other words, my dreams come true before the question has been answered. In those circumstances, I will always sell stock, at least enough to get my remaining position for free, but very often the whole position. Similarly, in speculation, if I buy a stock with an expected outcome and my early warning system, that is the news events that I monitor to give me some sense that my speculation will be unsuccessful, if they start to flash, what that means is that my reason to own the stock has gone away and the stock must go away. Too many speculators buy a stock at $1, say, the stock falls to 60 cents and they say, well, I'm going to sell it when it goes back to $1. The problem with that thesis is the stock has no reason to go back to $1. Best to recover 60 cents than to see the stock go to zero, in my book.
One of the biggest mistakes we see investors make, you just detailed, but people spend like 99% of the time on the decision to buy and almost nothing at the time of the decision on a plan on how to eventually sell. We see that all the time. In the fund world, a classic example, when someone makes an allocation, you hear it a lot where they'll say to the manager or the strategy or whatever, hey, I'm really disappointed. I don't understand why this fund or strategy is doing so poorly. I'm going to sell it. Almost never will you ever hear, hey, this fund is actually doing way better than I expect. I'm concerned and I'm going to sell it. Right? It's because people, the way they think about it, they don't plan it out ahead of time. And I think a wonderful exercise, and we also talk about this a lot on the podcast with just your life, financial planning, being a CFO of your household, of writing down a plan for your portfolio for any outcome, inflation 10%, deflation, gold at 5,000, gold at 100, stocks going up another 50%, stocks going down. All these outcomes on how you rebalance, how you think about it, I think is hugely instructive to at least think about it and hopefully put pen to paper because you'll have a little higher compliance. I was also laughing when you made the Mike Tyson because there's a billboard that's been in LA on the highway near my office for I don't know how long that's advertising Mike Tyson's new cannabis ranch in Nevada. And so maybe we'll have to update the quote to be something like, everyone had a plan until they went to Mike Tyson's ranch and smoked a bunch of pot and sat on what's supposed to be the longest lazy river in the world. I don't know when it opens, but it's going to be, I'm sure, a sight. A couple of quick questions, and we're eventually going to have to let you go. You've been very gracious with your time. So say when someone wants to get up to speed, you guys offer a ton of education and videos at Sprott, but what are some general resources? It could be books, conferences, people to follow, anything that you think would be helpful, people that really want to cannonball into your world of natural resources and investing?
Well, your audience will be familiar, I think, with the first reference I'm going to give you, but I think it's important, and it isn't specific to resources. For most investors, whether they're new investors or old investors, simply reading The Intelligent Investor by Ben Graham and then attempting to employ the lessons will improve almost everyone's investment performance. I need to remind myself of that fairly constantly to avoid making the mistakes that Graham jokes about. The second circumstance is self-serving, really. As you suggest, there's about 200 hours of educational material on the Sprott website, and the price to access that is excellent. It's free.
Do you guys still call it the Mining College?
Yeah, we have the Mining Investment College there. We have a discussion of ore bodies. from a non-technical point of view so that you can begin to understand what the words mean. There are probably 60 instructional videos by Sprott US Media with many commentators, myself included. And it's important to note that all that stuff is free, which is a really good start. What tends to happen with curious speculators is that they will see a theme in one of the videos, and then they'll begin to research that theme themselves individually online, which is really a good thing to do. Probably the most practical applied help that I can give your listeners is an offer that I love to make, which is if your listeners are already natural resource investors or speculators, if they email me a copy of their publicly traded natural resource investments, email it to me at rankings, rankings, at sprottglobal.com. I will rank those portfolios, at least the companies I know, on a 1 to 10 basis, 1 being best, 10 being worst, and comment on the stocks where appropriate, and email those rankings back to investors on a no obligation basis. That's a really, really, really good way to start. I like to have my own portfolio ranked by people I trust so that it causes me to think differently. It's important if somebody takes advantage of that they include both the names and the symbols in the text, not as an attachment. Our security people here don't like me opening attachments from strangers.
That's an incredibly generous offer, listeners. Rick, I'm going to apologize because you're probably going to get about 1,000 emails, but an incredibly generous offer for someone who's been involved in this space for multiple cycles and decades. And like I mentioned earlier, there's no other industry where the importance of probably being a people business and knowing some of the best operators versus also it's a world where, it's filled with people who are maybe not the most ethical and moral operators and fraudsters, et cetera. Being able to separate the two is probably in no other sector important. So be respectful of Rick's time, you guys, but take him up on it. That's a very thoughtful offer.
I really enjoy the process, Meb, so bring it on.
We like doing the same. Although listeners, I'm definitely not making this offer, so don't email me. but we often review new client portfolios on funds and investments, and often they're pretty good, but a lot of times simply avoiding the really, really, really bad basic mistakes is equally as important. And by the way, those resources we've read and listened and downloaded a lot of what Rick's talking about. We'll add them to the show notes, mebfaber.com/podcast for listeners. So you'll have all the links, et cetera. From someone who's been to, I can't even count or pronounce the countries, looking at properties all over the world, we like to ask guests on the show what their most memorable, it doesn't have to be best, it could be worst, it could be neither, but most memorable investment over their career has been. Do you have one that comes to mind?
Well, my most memorable investment is probably speculating in 1999 in the uranium space, which was ridiculously oversold. It was my best contrarian call, certainly, but it was also instructive because I was way early, first of all. And although I was right, the sector fell sort of uniformly 30 or 40% after I made my investment. In fact, my finest investment, my best speculation fell by 90%. When that happens, you have to re-examine your precept, which I did. And after having fallen by 30 or 40%, I had a 5-company portfolio. The worst company in the portfolio, the worst, increased, this is hard to believe, 22 times. The best did substantially better than that. Probably the most interesting trips that I have taken, as you point out, I've gone to a lot of countries to look at exploration projects or development projects or mines or oil fields. Probably the most interesting visits that I have made have been to places like Congo, really, really fractured societies, post-conflict societies. Sometimes you use the word interesting in an odd sense, and certainly my early visits to Congo were more tragic than anything else. But if you want to experience the world outside yourself, the stranger the place that you go, the better the experience you have. And by the way, what I would call industrial tourism, that is going to places not as a tourist, but really as a participant in their economy and a participant in their society, and seeing the things that they think are important or interesting for you to see, is a much better experience from my point of view, at least, than being informed by National Geographic or Condé Nast or something like that.
Sounds like a second career for you, Rick Rule tour guide. I, for one, would love to listen to a podcast or read a book about all your stories. It's like the Jim Rogers version of natural resources all over the world. It's got to be fascinating. I imagine that would go on for many hours, many hundreds of pages. So that's a to-do list for you this decade, Rick. I would love to hear some of those stories.
Well, the podcast will be good. I don't think I'll be a tour guide. The idea I take people to northeastern Congo in a war zone is not something I'll probably do.
Yeah. Rick, it's been a lot of fun. Where can people learn more? We talked about it a lot already, and we'll add them to the show notes, but just a real quick reminder. Best places to find you, what you're up to, what's going on in your world.
Best place to find me is either www.sprottmedia.com or Sprott Media at YouTube, or at our website, www.sprottglobal.com. But the best way to get specific information from me about what your listeners are most interested in, which is their own portfolios, are, as I say, to email me those portfolios at rankings@sprottglobal.com.
Awesome. Rick, thanks so much for taking the time today.
Always a pleasure. Thank you.
Welcome, podcast listeners. We have a monster show for you today. It's almost 2 hours long. It might be our longest ever, and I promise you it is well worth it. Our guest serves as the principal and global chief economist at none other than Vanguard. He is a prolific researcher and investment writer, also head of the Vanguard Investment Strategy Group, whose research team is responsible for helping to oversee the firm's investment methodologies and asset allocation strategies for both institutional and individual investors. In addition, he's a member of the senior portfolio management team for Vanguard Fixed Income Group, which oversees more than $500 billion in assets under management. In today's episode, we get into the broad framework of Vanguard's research and some depth on the thinking and process involved. We walk through some current thoughts on a few different asset classes and their Vanguard Capital Markets Model. We even covered Vanguard's most recent 2020 outlook and their projections for global stocks, global bonds, what looks good, and what to avoid. Stay tuned to the end of this conversation as we discuss the concept of the idea multiplier, a fresh way of thinking about the evolution of knowledge and innovation. The research effort was an incredible undertaking, and you don't want to miss their findings. Please enjoy this episode with Vanguard's Joe Davis. Welcome to the show, Joe Davis.
Thanks, Meb, for having me.
Joe, this is going to be a lot of fun. We're going to get into all sorts of stuff today. First, you're calling in from Pennsylvania, I assume. Are you on the Vanguard campus or are you at home? Because I hear that's almost the same thing.
Yeah, I grew up 10 minutes from Vanguard's building, but I'm at our campus. We're about, for those that don't know, Vanguard, we're outside we're in the Philadelphia suburbs, probably about 20 minutes from the airport, western suburbs along what some call here the main line. So born and raised here and now working here.
Out of curiosity, before we get started, were you aware of Vanguard growing up? Were you aware of investing in general? At what age did you sort of aware of this just enormous growing amoeba taking over the asset management world?
Well, I was aware. In high school, I was interested in economics. Actually, one of the first books I read was Random Walk Down Wall Street, the Malkiel classic, who I didn't know at the time, eventually served on Vanguard's board of directors. But my dad got me interested in Vanguard. My first exposure to investing, I had summer money from working construction and cutting grass, and I said, what do I do with this money? He's like, why don't you put it in a mutual fund? So I didn't know what a mutual fund was. So it was my first lesson in investing. It was around 1990, 1991. Of course, I will admit the first mutual fund I bought was because at that time, you recall, still the massive run-up in Japanese equity. So I bought the Vanguard Asian mutual fund. So I learned a good hard lesson of valuations, but that was my first introduction to the investing world.
It's funny, that just generated a random memory I don't think I've ever told anyone. I was interning at Lockheed Martin in the late 90s in a cubicle with 3 other engineers, and they were older. And of course, in the late 90s, everyone's talking about their 401k, and one of the guys was very smugly bragging about his investment in Wellington. And I was like, what is Wellington? I'd joke I'd finished my duties as an intern because you can't do a whole lot at aerospace companies when you're a freshman in college. I'd finished my duties by like 10 a.m. and didn't just spend the rest of the day on the internet looking up tech internet stock. So I had the same experience as you, but a different bubble. So I was,
but I did it again. Meb, here's the thing. I'll admit I did it again because now that was a diversified basket of securities, at least in the early 1990s. Now I go back to graduate school, my PhD. I'm down in North Carolina, down at Duke University in the late 90s. You can imagine that environment with the NASDAQ and tech. And I had a little bit of money, and so I had I was just in graduate school with my wife. I had a little brokerage account. And so I bought the first individual stock I ever bought in my life was in 1997. The ticker was AMZN, Amazon.
Oh, wow.
And I was an early adopter of Amazon. I didn't really know. I was just buying books there, books and CDs. So I'm dating myself with music. And so I bought a number of shares. And so I was both lucky. Some would say I was smart. I was also dumb because I sold it in 2001.
Oh, man.
So and I tell that to students, perhaps in a classroom setting. That's the story they're most interested in. They look at me like, how could you have sold it? And I said, of course, had I known, and it's actually a great lesson of bubble investing because everyone says it's so easy to spot. I said, let's be careful because many said Amazon was a bubble in the late 90s, but that's a whole topic in of itself. But yeah, I'm not afraid to admit it. I think you learn from your mistakes more than your successes, and that was clearly an investment mistake longer term, which has cost me a pretty penny.
Yeah, you can do the math on that from 99 today. I mean, I think it's probably 10,000 into 10 million, or at least a million.
Oh, yeah.
Something like that.
Yeah.
You speak to a couple things. One, the challenge is also, Amazon went through a 95% drawdown during the internet winter, as well as multiple 50% ones after. And the challenge of holding something like that is so difficult. Many investors, it's beyond comprehension. But you also talk to the very real benefit, and a lot of the younger investors probably scratch their head at this, but almost every successful investor we've had on this podcast has the same stories about losing a lot of money when you're young, making dumb decisions. But those are these scars that keep you behaving better in the future.
Yeah, and I think what it made me do is sharpen my pencil. Like in terms of just thinking about investing, active decisions, asset allocation decisions, which I still view as a form of active in some philosophical sense. But what are the assumptions one is making? What are the characteristics? Do those theses or does the data still hold in that framework? All those things, I actually go back to even those events and replay the tape. What would I have done differently? It was, though, a lesson of emotion in some sense, and the fear loss. But if I had stuck to a purely quantitative way, I would have been more likely to stay the course. But that's where I think sometimes forgetting the reason why you bought an investment or had that strategy to begin with, and just revisiting that in a more systematic way. That's something I had that in one sense, but to be more concrete about it would have been helpful, which is why in my current role, we spend a lot of time at Vanguard. I like to think we're very quantitatively oriented. Not that any model is infallible and certainly won't solve many problems, but to have a numerical framework that you continually both challenge the assumptions but come back to and let the data help inform to make decisions, I think is a really important framework.
Yeah. I spend a lot of time thinking about these mistakes and challenges of investing. The older I get, the more I think about the behavioral side, but not even optimal structures and outcomes, but even areas where suboptimal actually, if it helps you stay the course, is a much better investment. I used to scratch my head for the longest time about private investments. And I said, why would someone want all this illiquidity? But then it's thought about it long enough and said, well, it's because you can't pull up the Amazon quote on your phone every day. If you were locked in 99 and said you can't sell this for 10, 20 years, it's a different framework.
Yep.
We were actually recording this during the Charlie Munger is holding court in Los Angeles at he's chairman on, is it the Dow? God, what is it? Dow software company? I'm blanking on it. Anyway, so those guys talk a lot about Mr. Market, and showing up on a daily basis makes it a lot harder to behave, for sure. All right, so let's start with the depressing and then move to the optimistic. You're a prolific writer. I had a lot of fun last couple of weeks reading not just Vanguard publications, but a lot of your academic literature. But let's start as we turn the page on the last decade and getting to a new one. You guys put out a nice 2020 outlook with the headline, Subdued Returns. I don't know how many people just stopped reading after that, but walk us through your thesis. Walk us through kind of how y'all look at the world in the beginning of 2020.
There's 3 points I'd like to make. One is our approach. And for those that have read our outlook, I mean, we'll talk a lot about the near-term economic risks in the environment, but I think the broad framework of our market outlook is to really look in a distributional sense. I mean, I'm proud of us as a firm. Our first publication, this annual publication, was 2009, 2010, and some will criticize us because they want shorter-term market prognostications, point forecasts, as we call them. We refuse to do it, but that's because I think we're just honoring the predictability the modest predictability I think that we have. And so that's the framework that we've been living under. And then within that framework, the second point is that initial conditions, we know for asset returns, initial conditions don't really tell you much about equity returns over the next year. This gets to the whole literature that your podcast has talked around. Academically, they call it return predictability. But we tend to focus on the next 5 or 10 years because that's where there is some modest predictability in equities. I think it's also more important that horizon allows you to try to look through some of this noise and assess risk on a more asset allocation perspective. And when we do that, given the initial conditions that they do matter, where valuations are in the equity market, at least in the U.S., and where the interest rate and the term structure is, risk premiums they're not suggesting that the world will end, but it is one of subdued returns are more likely than not. I'd hope that, well, at least what I believe is that our outlook is not pessimistic. We believe we're being reasonable. Now, the recent returns have been very strong. In one sense, they may be laughing at our outlook, which the market may be right. I just think the odds are stacked against it on a 5 or 10-year basis. And then the third point that we would make is that from an investment perspective, it's actually going to be a challenging environment because if we're right of a period of subdued returns, it means that for many investors, they're going to have to stay invested, yet they may not be rewarded for taking on aggressive risk positions. Which for me, I'm not a very patient person, so that sounds frustrating to me. It's actually a little bit of a frustrating environment, I think, if you're an active manager or willing to take on tracking error to a portfolio, because you look at most parts of the financial markets. Now, the coronavirus that's hitting now is starting to disrupt a little things, but it isn't like there's compelling risk premiums like there were 10 years ago. And for the record, 10 years ago in our first publication, we actually had to base a lot on our valuations and our approach. We had a 10-year annualized return for global equities that were roughly the central tendency was roughly 9%. It turned out to be that was pretty much right on the mark. Now, year to year, who knows? And that's why we wish we had that sort of precision. We never will have, but we were pretty much on the mark. The more narrow the market segment, the less information content we have, and the strength of the signal dissipates. So, the past 3 years, we've become more guarded, but it's this past year, we put a little bit more finer point on it, just as equities, particularly in the U.S., have just exceeded the fundamentals.
So as kind of walk us through around the world, I mean, I'm looking at your outlook, and it's got U.S. equities, a range of 3.5 to 5.5, let's call it 4.5. And in my head, that would have been a great real return historically, but that's nominal.
Yeah, it's nominal. Yeah.
And not too far different for REITs, global equities, a few percentage points higher, and then of course bonds. Maybe just walk us around the main asset classes. You guys put out a really nice publication called the Vanguard Capital Markets Model that a lot of these assumptions and inputs are based on. Maybe just walk us through it, kind of how you guys think about actually coming up with these numbers in general.
Yeah, so I give a little sense to everyone on your webcast. So it's funny, it's one of the first research projects I was involved with, Meb, when I started at Vanguard. Now that's, oh my goodness, 17 years ago. But this capital markets model, it is a global model where we model, in the technical parlance, an endogenous system, which means all these variables interact with each other. We look at core variables, I would call them risk factors, call them inflation, growth, valuations, the term structure of interest rates. And we do this for all the markets, all the primary markets around the world. And then you use that, there is some persistence in those variables. And of course, they interact with each other. And so when you move them forward recursively or effectively, you forecast them through time, that gives you over time a distribution of outcomes. So in one sense, it's like taking, for those in the money management industry, if they're managing portfolios, they'll have a risk factor model, their attribute performance. It's based upon the portfolio is going up because the factor X is going up and value factor is going down and blah, blah. Just think about that in a risk factor space, but we're evolving that in a time series basis through time. So it's a lot of cross-sectional variables that we evolve through time and where we're able to harness two things that I think are important, and certainly that's more important than what I think the financial planning community has generally used for years. And when I started on that research almost 2 decades ago, it tends to just use Monte Carlo simulation, just draws a distribution around the historical mean. But we all know, just even from fixed income returns alone, that's unlikely to get the historical average where the interest rates are today, which is a simple way for saying that returns are actually somewhat predictable on intermediate settings. And so we're able to harness that literature, but you still get ranges of outcomes despite us using valuation measures such as the CAPE for equities all around the world, the term structure of interest rates. They're still imprecision. And then, of course, we're drawing very rich tails based upon historical as well as our own sort of belief that in the future, the range of outcomes is always going to be potentially wider than what has happened. Because things could always have been modestly better and modestly worse than what has realized in history. So that's a general operating principle we have, but we do honor the initial conditions in the marketplace. And then we as a team in the investment strategy group, we will take a stance, and this was, I think, sometimes lost, is that the model is never left on its own because there's 2 primary decisions we have to make regardless of the math and the computers. And then one is, for what historical time period do you estimate these models? There's regime changes, historical. We try to use as much history as possible. Unless we believe the historical record, there's a big reason why the past is not necessarily prologue. And then the second one is we have to make a stance, and we have done that on occasion. We're doing that today, that the historical average level of outcome, so that bell curve, the average outcome will be different than what the long-run average in the data has been, because any model will converge to that long-run historical data. We've done that for 10 years, that we believe that because of our research, inflation, for example, the historical average historical inflation rate has been roughly 3 to 3.5% if you define the world as having started in 1960, which quite honestly is a pet peeve of mine. I think a lot of the investment world tends to define all of history as starting in 1960 because the data is clean at that point. Based on our research, we thought that the central tendency was closer to 1.5, below 2%, which is where central banks aim, in large part because of technology. And so even though we get a range of inflation outcomes, that in of itself, we're making a decision of where future inflation will go as a central mass. That's been important. That's actually helped us in terms of the accuracy of our forecast, because that has said all else equal. We also had a view that R star, the real base rate, the real riskless rate in the major developed markets, was certainly below the 1960 plus record, that we thought actually the 1960s and 70s and the 80s were biased upward when one looked at over 200 years. The average real short rate is around 50 basis points. So we generally tended to converge there. Now, the central banks have kind of come down to that. And not to say we've revised modestly those projections, that mean, down a little bit. But I say that because there is subjective. I mean, you could argue that's either subjective. I think it's informed by research and or reading history, but that's still an active decision, whether you use blindly history or you kind of override it. And that's sometimes not talked about a lot. Even if one had our capital markets model and was able to to use it to create our outlook. I think there's also just decisions that they have to be aware of that they would have to make. And I'm not saying ours are the right ones. They've generally been accurate thus far. And even with that, year to year, we're certainly not getting the investment outcomes in any one year. I mean, last year we had the same 5 or 10 year outlook, generally speaking, and everyone knows what U.S. equities did last year, very strong. So, but again, that's not the forecast horizon we're focusing on. We're trying to really nail the next 5 or 10 years.
It's funny you mentioned that about everyone knows what U.S. equities did last year, because they do these polls consistently and ask people if they thought the stock market was up, flat, or down. And it's like last year, I mean, it was up, I think, 30%. It was a ridiculous amount of people. I think it was the majority of people said flat or negative because of the geopolitical news flow. And I'll find it and send it to you, and we'll post it to the show notes, because the consistent amount of just negative media commentary on everything in the world, whether it's coronavirus, whether it's tariffs, whether it's politics, yada, yada, I think tends to have effect on people. Most pros know, obviously, because you're involved in it every day. But I think the general populace, it doesn't translate. Even in a monster year like last year. Anyway, we'll post to the show notes, listeners.
Yeah, that'd be interesting.
So I got lots of follow-on questions, and I figure we'll kind of go one by one. You guys have put out a great paper on the CAPE ratio, some thoughts on it. Would love to hear kind of a short summary on that paper, the concepts, how that makes its way into any of y'all's valuation models in general.
Yeah, well, I think if everyone on this podcast is familiar with the CAPE, or the cyclically adjusted P/E ratio, really from John Campbell and Bob Shiller going back years, the one thing that's been perplexing is that, I mean, ultimately our research shows that there's nothing wrong with the CAPE ratio per se. I think it's generally, though, how it's applied, in our mind, how at least I've seen it applied in the industry could be improved. And why I say that, I've seen charts where you'll look at the CAPE ratio, which is a good measure of long-term expensiveness or cheapness in the stock market, and people will say, well, the CAPE ratio is elevated. And they'll do that because they'll draw the historical average of the CAPE, let's say around 16 or 17, and compare that to today where it's elevated, and say, based upon that, the market is grossly overvalued and we're due for a significant correction. I'm being crude in my sort of characterization there, but that's the general gist, at least in the direct application of it. One of the things that our research has long showed, and that we've put in our capital markets model, and that we've published, and we've disclosed this so that others can read our methodology, is that I believe that mean reversion is the most powerful force in finance. It also can be the most dangerous. We believe mean reversion is conditional on other things. And so we don't think there's anything wrong with the CAPE ratio per se. And again, some are wondering if the CAPE ratio bias, in other words, is E, P over E, is the earnings. You know, Jeremy Siegel's got a paper out saying, well, he's got to use different accrual earnings. Someone say, well, do you look back 10 years? Maybe the earnings are different. Maybe you should look at a shorter window. You should look at forward earnings. Our research shows it really doesn't matter what earnings you use. The more important thing is to acknowledge that what is average valuation, what is the average PE that we should be comparing to, that in itself, the fair value, so to speak, I'll put air quotes around fair value, of any fund of valuation metric, in this case, CAPE, the fair value in of itself can vary through time because that in of itself is related to other key macroeconomic risk factors. And so, for example, what we would say is that the fair value CAPE that we should be comparing to the actual CAPE, which is elevated, that equilibrium level is higher than average because interest rates, particularly real interest rates, not nominal, real interest rates are lower than historical average and are at least expected to remain at that level. And so that's a double-edged sword. That means that the base rate, cash rate, and fixed income, those sort of rates are not going to provide the sort of nominal and real return, which is an ingredient in an equity risk premium that's on top of it. So that's negative. But it also means that equities are not necessarily, certainly aren't screaming overvalued territory because we shouldn't be comparing to the long-run average CAPE, which is alarming because if you just look blindly at the long-run average, the CAPE ratio right now is in unwelcome territory because any other time we've been, or the only two times we were higher than that, it was the late 20s and the late 90s, and that's always not a good peer group if one's looking out 5 or 10 years. We'd say, let's be a little careful of that, and that's the sort of corrections that we're making for in our capital markets model. In our fair value cape, when you were able to control for the level of interest rates, the real rates, and inflation and inflation volatility, you can actually improve these intermediate term or medium run equity forecasts relative to the traditional Shiller cape almost double. I mean, literally our out-of-sample predictability across many markets goes from roughly 30 to 40%, which is not bad. We were talking about 5 or 10-year returns, average returns. It goes to above 50%. And again, we'll see. I mean, things could change, but that's why we still believe that there's a subdued return environment. But that's when we talk about valuations, that's the sort of controls that we're doing. And it's because there's a fundamental linkage between earnings yield, which is E over P, the earnings yield, and then real bond yields. Not the nominal yield, but the real yield. And when people say to me, we're in a somewhat lower growth environment globally, in a low interest rate environment, but then some will then say, well, then they're very concerned about the cape ratio. I said, well, no, if you just said that if we're low growth and low real yields, that means by definition, then we're going to have lower earnings yields going forward, which means the equilibrium PE ratio is higher than the historical average.
I think it makes intuitive sense. I mean, you see a lot of research out, and some of this translates to kind of what inflation is up to as well. When you have these sort of moderate inflation environments, it makes sense for people to want to pay a higher multiple because you're not at risk at either the dual sort of problems of outright deflation or high inflation. And some of that translates to, as you mentioned, real interest rates and et cetera. But I feel like it's really hard for investors to think in terms of real versus nominal.
Oh, totally. In fact, the first year we did our Capital Markets Outlook in 2009, and we presented the quant in me, the academic in me said, well, we got to get out inflation or get out the cash rate to talk about risk premiums. But then I found that people were saying, what do you mean by talking about real returns? So I got to add inflation back in. Why am I doing that? Can't you just tell me what the nominal return was? So that was the last time we just solely showed real returns, even though I think that's a natural thing to do, and generally how we model it inside the capital markets model. And again, I still just want to underscore is funny is that even with our, I think, improved framework, and history will tell if it truly is improved, but from all the evidence we know, it is, but we're living the out of sample as we speak. But even with all that improved predictability, we still have wide outcomes. But this is the best that we're doing. I think we are doing a justice to smart investors to say, here's the full range of outcomes. And I think even firms or asset allocators or strategists that don't do that and show a point forecast, when you really ask them, they'd have a distribution in their head. What we're trying to do is show investors who are trying to make decisions under uncertainty. I think if we're really successful, we'd have to do three things. We have to show the full range of the distribution. We have to give them that methodology of where is this bell curve coming from, right? Qualitative or quantitative or some combo. And then third, in certain scenarios that they're interested in, show them both. What are the payoffs and the probability of that happening and the payoffs that being right, but also the downside risk and the probability that they're wrong. And then let them make informed decisions. And I think that third component that we've been doing, focusing more and more, and you see that towards the end of our outlook this year, and that's where active management comes in. If one feels very strongly about a scenario high inflation scenario playing out more than a global recession scenario, that's where the active management comes in. I think our group is responsible for saying, okay, if you care about these states of the world, what matters and what doesn't in those scenarios, because sometimes it's surprising. And then secondly, what are the probabilities of those and what are the trade-offs if they go wrong? And then at that point, it's up to the advisor, strategist, investment committee, whomever it is, to make the decisions as they see fit.
Well, I laugh because somebody was talking about all of these strategist expectations for the stock market next year, and let's call it, or it was like a range of -2 to 10%, somewhere in there for stocks next year. And I said, if you really wanted to be the number one strategist every year, all you have to do is predict either stocks are going to do higher than 10% or less than -2, because that's the vast majority of outcomes. That's like 60+%, because any given 1 year, the returns are extreme. Over time, 10, 20 years, they usually coalesce to the numbers we're talking about. But any given year, anything can happen. And so I always say, if I was in that prediction for all the Barron stuff, I would just name a really high or a really no number, and chances are you're going to win.
I would do the same thing. In fact, when you were talking about, I was going back to my or days growing up, I remember the game show. Some may not know what I'm talking about. The Price is Right. And to get on the show, you'd either guess $1 when that product was up and everyone else says $700, $800 for that washer and dryer. Either you bet the highest bid plus one, or you bet it was $1. Because most of the times it was well outside that tight range. And I think people do anchor. I feel that in the economics world, if you hear the consensus outlook for growth, I don't know, for the U.S. is 2, you already start thinking, oh, is it going to be slightly higher than 2 or slightly lower than 2? And so there's that behavioral finance, that anchoring that's powerful, which is why I think that's where the analytics is really important. I never would want to throw out human judgment because we can't model everything, but I think that's where that process keeps us honest. I know for us, when we have internal growth forecasts, our capital markets forecasts, because we ourselves we're not immune in any way, shape, or form to the market sentiment and concerns, positive or negative. And so that at least keeps us honest in terms of we are much less likely to be swayed by the data flow because we use as much big data as possible. We still know that we have a large imprecision in our projections, but at least if we're going to make a change in our outlook or a material shift on either the economic or the market front, we know it's effectively gotten over some hurdle that's bigger than any one person at Vanguard, and it's bigger than any one data point. And I think that's at least a good thing, because then we're less likely to be swayed, because even economic growth projections or market earnings projections or estimates, they tend to move in a 6-month cyclical fashion. So we're trying to minimize the influence we will feel on that. We know we'll still feel it, but we're trying to minimize that influence.
Let's take a quick break with a word from our sponsor. Farmland is something near and dear to my heart. We've had farmland in our family for generations. As an investment, I find it all the more interesting. Shrinking supply of farmland, coupled with increasing demand for food, presents a simple supply and demand setup that has been a contributor to the exceptional resilience of the asset class, generating almost 12% average returns for the last 30 years without the big daily price swings associated with other public asset classes like stocks. But despite roughly $3 trillion worth of farmland in the U.S. and rapidly growing private equity presence in the space, it has been extremely difficult to invest in. Enter Acre Trader. You can invest in high-quality U.S. farmland in just minutes online. At the core of Acre Trader is a highly qualified team combining decades of experience in financial services and agriculture. Those guys know dirt, they know farming, they know finance, and they're ready to make it all work together for you. Check it out at acretrader.com/Meb to learn more. And now, back to the show. So you guys put out last year and consistently some of my favorite pieces on international investing, and Vanguard has long beat the drum of having a global perspective, which humorously differed a little bit from your founder's perspective. So according to the outlook, stuff across our borders looks a little bit better. Maybe talk about the opportunity set in foreign stocks and how you guys think about incorporating that into a portfolio. Because according to Vanguard, most of our listeners here in the U.S., they want to put it all in the U.S. stock market.
Yeah, well, and to be fair for your listeners, I mean, that's seen relative to U.S. large cap the past 2 or 3 years. It's just underperformed. I mean, you almost don't even need a terminal or an access to the internet to make that statement. I mean, it's just been eye-opening and how strong the U.S. has done. And you mentioned Jack Bogle, rest in peace, our founder who passed away. Jack and I, we agreed to disagree, let's put it that way, and I have the most respect for Jack. He just was not as big of a fan on international investing, thought you got most of the exposure, the benefits from a global portfolio investing in the U.S. large corporations. Our data would say, Jack, you are missing some extra free lunch from the diversification angle. And so I'd say just 2 things I'd say. One is from a strategic perspective. I think we are in fairly safe ground saying that the global portfolio is the most efficient portfolio. Now, that does not necessarily mean, and that's just the highest ratio of return for risk expected. That does not mean, however, it will be the best performing portfolio. And I think going forward, our projections, the average differential over the next 10 years for international equities, non-U.S. equities, is roughly 300-400 basis points average return higher than the U.S., which is a sizable. I mean, that's half the historical risk premium? I mean, that's pretty sizable. There's 2 primary ingredients for that. One, I have more confidence in than the other. The first one is, and again, it's all being driven from our capital markets model. The one is just the valuation differentials right? So where outside the U.S. haven't seen as much of a move to the upper end of the fair value band. So that's generally speaking a modest tailwind. But then the other tailwind is the expected depreciation in the U.S. dollar on a secular basis. Now, we will be the first to say we don't have a strong qualitative sense on the dollar on a 5 or 10-year basis. We're not bearish on the U.S. economy. Where that signal is generally coming from is the intermediate term predictability of modest carry returns or performance of various currencies relative to some purchasing power parity, which are all being reflected in the yield curves. So part of the reason for U.S. our projecting of non-U.S. equities, some portion of that, not the full portion, but some portion of that is because of an expected depreciation in the U.S. dollar, which again, being currently reflected in U.S. and international interest rates. Again, I have a little bit more confidence based upon our research, a little bit more confidence in valuation tailwind than I do just on us having precision on the currency effects. But it is there, and it is showing up in the projections. So, I mean, that's where we will start most investors as a starting point is significant exposure, roughly almost 40% of their equity portfolio to non-U.S. securities as a starting point, and then go from there based upon their sort of risk preferences or their active views. But again, it's on the past few years, international equities have clearly underperformed U.S. I do say there's a limit to that outperformance, but could it happen this year? Of course it could.
Yeah. So I always reference, and I'm curious because in 2020, if you look at the global market portfolio that you've kind of referenced a few times, you can get pretty darn close with a couple Vanguard ETFs. And I think it's down to like 2 now. I think that you guys got a global market cap weighted equity and a global market cap weighted bond. When you guys just going to put it all into one and just do the global market portfolio and be done with it? I
mean, it's kind of amazing that you could, I remember learning in school the whole CAPM portfolio. And of course, it's been extended in multi-factors ever since. But I mean, I think as an industry, and we're certainly not alone in this, but I look at the asset management industry, which at times gets criticized for a number of things or concerns about different things. I think the one thing that's been lost at times is all of us as investment professionals and asset management companies, how we've been able to provide investors with a wonderful piece of technology, which is a portfolio of thousands of securities, whether they're fixed income or equity, at fraction of the cost it would have taken to assemble that portfolio even 20 or 30 years ago. Sometimes I personally take it for granted, but being at Vanguard and the amount of skill and effort and technology it takes to do that, I think it's a wonderful consumer surplus. We had a paper on this last year that came out from our team. We called it "What is the Mutual Fund Worth?" and try to quantify that. It's been billions and billions of dollars because it's allowed investors theoretically to get the closest than they've ever been able to get to the efficient frontier of broad-based beta, at least as a starting point for their portfolio.
As we've been saying last few years, never been a better time to be an investor. There's a kind of a good segue talking about the U.S. dollar. I thought it was interesting talking about the purchasing power parity, which to the listeners, if you're not a big Forex person, goes back to the days of the old Big Mac index the economists used to put out. But that kind of leads us into a segue about bonds. And I imagine, and you can correct me otherwise, but when you were doing your grad school down in Durham, I imagine the textbooks weren't filled with a world of negative yielding sovereign interest rates. Talk to me a little bit about how an economist thinks about this development over the past 20 years, where maybe in places in history you've had patches of negative yielding bonds, but never on the scale that we do now. When you have your economist hat on, how do you think about that?
That's just been amazing. And that's something that, no, it was never talked about. In one sense, it was never said explicitly that it couldn't happen, but it was almost because it was on no one's radar set or experience set. Why would you even talk about it? And it's funny, and even for me, I'm a big fan of economic history. It's actually what my dissertation was on. And, I've long looked at charts. You can go look at interest rates back to almost the Roman Empire, and there's a lot of bad stuff that happened now and then throughout world history, and you don't see the yields of those interest rates going below the zero line. If anything, they were higher during bad times, not lower. So I think two things. One is I think the And again, part of this is us now being able to have some experience in this situation. I'd say one, economic. I have a personal view on from a monetary policy perspective, and then I also have what I think is being an underappreciated factor, although it has been talked about in terms of why we have negative interest rates. I think just as a monetary policy making framework, I personally have been of the view, and I'll be stubborn to get off this view, that I think negative interest rates are a mistake. Why I say that is, the whole rationale or logic to take interest rates negative is that it assumes that inflation, nominal yields are real yields plus the inflation, expected inflation. And there's risk premium in there too. But the assumption is when you take the nominal rate negative, that the real rate will go then negative, which is why it's stimulatory, right? Which is why central bank does it. And that inflation expectations will either stay constant in that formula or will, if anything, go modestly up. And I have long worried about when you have negative nominal interest rates, it's not necessarily clear to me why inflation expectations wouldn't come down. And we've even started to look at how inflation expectations are formed. And so that's why I just had concerns about it, because if one can't answer that definitively, no, Joe, it will not drive down inflation expectations, then I would be very reluctant to use that as a means for monetary policy stimulus. And again, this whole debate isn't ended. We still have the ECB. They're starting to get a little bit more defensive in their movements there, trying to defend it more. I think there's behind the scenes, the BIS, and certainly the Fed is very reluctant to do it. I think that's a good thing. So I think that's one. I think secondly, one of the reasons, and we've been able to quantify it to some extent, one of the reasons why we have such negative interest rates, besides secular forces, which we have long focused on, we focus on three big secular forces to try to get a sense of what we call paradoxes that can emerge in the world only when you account for these paradoxes. And there's technology, there's globalization, and there's demographics. All of those point to lower, at least at the present time, lower real rates and somewhat lower inflation. That can get you close to the zero bound. The other thing I think that's been underappreciated is that I think the irony of, there's two things I think have been underestimated, and one reason why I think we have a little bit more negative interest yielding debt than I certainly would have thought 5 or 10 years ago. One is the diversification power, effectively the utility of fixed income. The irony of the low interest rate environment is that the utility of fixed income has actually gone up, not down, because of the correlation, at least on a rolling basis. It's been the past 10 to 20 years have been the most diversifying high-quality fixed income relative to equity when equities do sell off. I think there's a greater appreciation of that. Effectively, that's another fancy way for saying that the market's not too worried about inflation risk premium in the 70s coming back. But regardless, that can explain roughly 50 basis points reduction in long-term interest rates is the powerful diversification, in fact, a negative correlation to a high beta asset such as equities. So that's been, I think that's been really important. The other thing is the irony is, and I got to be careful with this statement because some may throw the phone at me since I'm on the phone here, and that is the irony of the global financial crisis is that today we may have a shortage of debt in the world. And why I say that is I think I could make the argument we have a shortage of high-quality safe collateral, which is why you have a big-time pressure on short-duration, high-quality assets that has pushed some into negative territory. But there have been some academics who've made that argument. I think all of these forces are working at the same time. We haven't been able to triangulate to the basis points how all of them are working, and some of them are not permanent. Some of them, though, will stick with us for several more years, which is why our fair value estimate, certainly for the 10-year Treasury, which is kind of a benchmark interest rate, ironically, we're 11th year into the expansion. Our fair value estimate for the 10-year hasn't changed in 4 or 5 years. And that was with the expectation that the Fed would raise rates off the zero bound 5 years ago. It's because these other forces that are more than offsetting our high level of debt, which is continuing to grow on a trend basis.
So you're putting on your crystal ball, take it out of your desk, from under your desk. U.S. interest rates, ever a possibility they go negative? Is that a scenario that is fathomable?
I think it would be more likely to see intermediate or long-term interest rates go negative than the short rate, which sounds really crazy. But I just think the Fed will be very reluctant to take it. I mean, I could see the 2-year, for example, getting negative. If a recession comes and the market really starts to price it, I could see it really prices just skyrocketing. If equities were down 30, 40, 50%. I think the Fed will be reluctant to take it into negative territory because of two things. One is the Heisenberg principle, which means just the very fact of observing Europe and Japan and seeing the mixed record may alter your own decision. And that secondly, just how the capital markets and I think the capital market system in the U.S. and the importance of money market funds and other short-term funding markets, where that's our biggest benefit, had negative rates. So I don't think we'll see it. I think what we would see is a much greater likelihood of a pairing of the Fed with the Treasury, either formally or implicitly, to get us out of the next downturn if the shock was very significant. I mean, clearly quantitative easing would occur, but I think that would be the next stop. And it would be quicker. It still could be delayed and lead to another leg down in the markets because it's tough to coordinate that. But that is what we would see before I think the Fed would start taking it down 50 or 100 basis points. The only thing that would change that, I think, Ben Bernanke has talked about this and a few others. If we do, I think we will live in a world at some point. It's just not going to be the next 5 years is my best read of technology. But until we have digital currency as the baseline across the world, you're unlikely to see negative interest rates multiply in significant fashion, and certainly not to the level that, in theory, you would say would really start to jumpstart spending. So I don't think we'll see it.
All right. So as I kind of flip through your outlook and projections, I mean, we're talking 4.5 US, Global X, 7.5 bonds, somewhere in like the twos for most of them. You guys manage in the trillions. You talk to a lot of institutions that also manage in the billions. The average pension fund in the US, whether it's public or private, still expects 6.5, 7.5, some 8, 9%. The average investor, if you survey around the world, always says they expect 10% returns. What do you say to them? Like, what's the general takeaway commentary? Are there any solutions? Is it just everyone lever that puppy up? What's the general conversation you have with all these big money and even people listening to this that have much higher expectations?
The conversation usually hits on one of three topics, and usually all three of them. One is, Meb, is like, listen, we will honor the fact and show the probability of their return projections if they have them, and some do, and spend a lot of time focusing. It's not impossible. I mean, they get a 5% real return. I'd have to look at exactly what the number is today for an 80-20 portfolio. It's like, oh, okay, that could be 30-some%. Like, it's not like it's some return expectations, 7% on a high-quality fixed income portfolio. That's like close to zero. And I only say close to zero is because there's usually legal disclaimers we have, so you can't say something completely without any that has zero probability of happening, but it's extremely low. And so I think we show them distribution. They could be right, just saying that as best as we can tell, and we go through all of our framework, it's just the odds so much against you. And so that's why we're trying to be realistic and say what the most likely outcome is, and saying that, again, you can then think if you have that as a central tendency, that's important because and for some investors, I said, listen, if they have very unrealistic, in our judgment, unrealistic return expectations on the secular horizon, walking them through A, what would need to happen for that to materialize, or B, quite honestly, saying, listen, I don't believe respectfully that hope is a strategy. I just think the odds are stacked against you, and just know, eyes wide open, the sort of downside risk that you may be exposed to there. And maybe there are some other levers that one could pull in one's portfolio to help close that gap. The biggest thing we've been saying is, and it's not great. I mean, sometimes this will feel, to some maybe, like my family, it feels like a conversation of, when I was growing up, of eat your vegetables. You're telling me that I have to save more, I'm going to have lower returns. It's not a conversation that gets you excited. Sometimes it's not a conversation that gets you on TV. And I think both of those are fine because I think that's a conversation that I think is a good starting point to have. I would love to see the returns over the next 5 or 10 years be in the top quarter of our projections. That would be great for my retirement plan, and I imagine for everyone else who's listening to this. And again, I am not saying it's not possible. I am not a curmudgeon by nature. We are just showing where the math and the framework is. And again, where I think we do have some credibility is that 2009 and 10, when, quite frankly, I got tired of hearing the phrase new normal being displayed, that there was no hope for a decent return in a balanced portfolio. I said, listen, the market is priced in a fairly somber economic environment. We were projecting actually above historical average returns. And I remember getting a lot of pushback for that, Meb, and having some doubts on some of those jury days myself. And if anything, we were too low in our projections for some parts of the market. And so I kind of pulled that lesson and that environment back, because here we are on the exact, I think, on part of the other end of the spectrum, where you want to have, I tend to find more investors who are saying our return projections are too low or a little bit too pessimistic than I do find saying that we're too optimistic. The contrarian in me and the fundamentalist in me tells me actually we're probably more likely to be right than wrong, because the sentiment tends to be countercyclical. But I don't know, that's the conversation we're generally having. I have not seen return projections out there for the most part that are wildly off, other than few when they start to hit the 9-10% range for an 80-20 like portfolio. So I have seen some institutions have that, but most institutions, most investors have ratcheted it down. I think what the fixed income markets have done and seen dividend yields and nominal yields come down, I think people have been marking down their return expectations a little bit.
Well, it'll be interesting to see how a lot of these underfunded pension funds, you would think, given the returns of this past decade, that everyone would be in great shape. But consistently, a lot of these funds aren't. And it'll be curious to see how a lot of these guys resolve any potential subpar return environment with their already sort of chronic underfunding. I don't know.
It's funny, Meb, you talk about that, because it's discount rate. With the academics on your show, it's what John Cochran always talk about, the power and discount rate. But I tell you, that's done some damage. The savers, the pensions have lost, there's winners and losers in every battle. They've clearly been on the short end here now. But I think that would cure, I think the best thing that could happen to the world would be a 200 basis point rise in real yields across the board. It'd be great for our long-term return projections. It would raise the efficient frontier across the board by 200. It would help savers as well as investors. Now, getting from path A to path B, even if that occurs, is probably going to be uncomfortable, but for a time. But that's the biggest challenge: is can we live in a world where we have higher real rates?
Yeah, interesting. All right, let's start to transition a little bit to some other topics I really want to chat with you about as we move, as I mentioned, from a little bit of the more somber part of the conversation to some ideas that you've published over the past couple of years that I think are pretty unique. The one that you and I had been kind of conversing about online for a while was culminated in a new paper you've published recently called The Idea Multiplier. I would love to hear you walk us through that, and also the whole process on compiling the data and the framework and the inspiration for the idea on this paper.
Yeah, thanks, Meb. So what got us on? So The Idea Multiplier. So we got on this project because we as a team, I think the entire industry is struggling to explain why the sort of dichotomy in the world that we have. I think we have technological disruption all around us, yet we don't have measures of commercial innovation rising, which means, economists say productivity. I think commercial innovation, GDP per person, revenue per worker, whatever it is, those measures on a trend basis have certainly been lower than historical averages. They've been low for 10 years, which that's why we have lower economic growth, lower growth world, and that's why we have a low interest rate environment. So when anyone says, well, why is growth low or why interest rates are low, I said we have to answer that question if we're going to get a diagnosis of where the world economy and where the financial market's going to be 5 or 10 years from now. I was struggling to answer that question, Meb, of explaining why commercial innovation is low. And so that took us on a path we didn't anticipate coming here. And so what we believe we have found, and we believe it's robust, and we disclose all the empirical methodology in this paper, The Idea Multiplier, we believe it's one of the first leading indicators of commercial innovation that has been sort of formulated. I grew up in graduate school, the so-called commercial innovation is what drives economic growth over the long run, output per person. And I was taught in graduate school, it's pretty much a residual. Now, Paul Romer won a Nobel Prize years ago. It's called growth theory, endogenous growth theory, that ultimately is a function of human capital. Really, what he was saying is that it's a function of how ideas form. And that's where the motivation of the study, where my sort of motivation or intuition grew. And my intuition was in a world where we're concerned about globalization peaking with respect to trade, and it was purely intuition. My intuition was that globalization, in terms of the exchange of knowledge and the building of ideas, could be accelerating through competition as well as collaboration around the world. If that was true, that we could see a pickup in commercial innovation and hence even growth and even real rates. I'm talking like R star. But that was just an hypothesis. So we started doing some digging and we threw a challenge to ourselves. Could we measure the creation of ideas in real time going on around the world? And so we accessed a database that pretty much only libraries use. It's a database of all published research in the world across all languages and all topics, all disciplines. Libraries use this to not only when you go into a library and say, okay, I'm trying to find an article or a book on something. Not only that's useful, but it's also they use it to even rank academics in terms of their impact on the profession. Like how well cited are they? And so that's what we did. We effectively traced the evolution of knowledge of idea networks and how they're spreading in real time and did it historically and all the way up to today. And so we created this measure called an idea multiplier. And so what we did is we accessed 2 billion records. And so of those 2 billion records, we not only downloaded all the ideas, so these were all published research. We not only downloaded all the ideas, we downloaded all the citations of all of those articles. So you can imagine the massive amount of data this was. So we used big data techniques and analytics on the cloud, and it was a monster exercise. And why that was important is that then we were able to screen the data and look at two things. We were able to only trace the evolution or the spreading of influential ideas, because these are ideas, if they're influential and they're being cited by others, either in agreement or disagreement, leading to new further ideas. And we did that across all industries and over time, and we did that end result is what we call our idea multiplier, which has been, and it turns out that leads actual productivity, like GDP per person, the stuff that I thought was a residual, it predicts it 5 years out. It's robust to other controls. And we show in the paper, and so I encourage the readers, if they really want to read all the details, it's been stagnant for 15 years. The ideas have been multiplying at a ratio of 200 ideas for every influential one. And over the past 18 months, to our surprise, it's really started to rise. And I think it's rising for two reasons. One is particularly China's human capital contribution to innovation is starting to move the dial more than it ever has. And secondly is building block technologies. You can think of things like the cell phone or digital or cloud and big data. They're starting to what I call smash together, which are starting to lead to new insights in fields that have nothing to do with technology per se. So that's encouraging. We were not expected to find it, Meb. It tells us we believe we found the first upside risk to global growth because we've been on the lookout for it and haven't found it. There's a lot on the negative side. We haven't found something on the positive side. It truly is. I'm not kidding. It leads growth. We're not going to see this the next year. It leads it 4 or 5 years out. Again, we were not looking to find this. But the cool thing is that it gives some sense of where the next great ideas will come from, like what fields, what industries they'll come from. Because our idea multiplier really popped. It tends to pop before you see the commercial innovation rise in those sectors where growth takes off. For example, our idea multiplier really popped in the field of computers and technology in 1988, 1989, the early 1990s, long before the commercialization of the internet. Now, again, this has no idea what company will come out, what actual idea, but it gives at least some sense of if we are going to see a pickup in genuine, I talk about organic global growth, not some sort of stimulus-fueled temporary fix. It has to come from a genuine rise in commercial innovation. Think of like the late 90s. And this says that is at least possible and certainly more likely than what I've been given it credit for or assigning the probability to. I'd been assigning a fairly low probability to it. And we have more work to do on it, but it is encouraging, and it starts to identify the 3 or 4 fields that could, in theory, have as big of impact on growth as the internet did in the 1990s. So I think this is an important contribution out there. We would hope others take this methodology. Hopefully they could improve from what we've done. I mean, I know they could. But so I'll pause there. It was a cool thing, and we did not anticipate finding this result, but it is robust to our sort of testing.
Well, I love reading it. I've been through it 4 or 5 times now, and listeners will post, obviously, the link on the show notes, mebfaber.com/podcast. And it's funny because over the past handful of years, I've been talking about valuation and chatting with investors and talking about what we were talking about earlier with mean reversion and valuations. And often I would say, look, the future is a spectrum of future probabilities. And I said there's plenty of ways these resolve themselves. Obviously, the market could crash. It could go nowhere. Valuations could go up. You could have growth just be a massive renaissance and go to the moon. I said people would say, what could cause this, Meb? And say, I don't know. Elon Musk invents free energy or finds something in the crust of the moon. I have no idea. But the interesting part about what you guys talked about is exactly what you just outlined. Maybe talk to us a little bit, because this was a bit of a surprise to me. I mean, it's not a surprise, but it is a surprise. Maybe about the industries that this was kicking out as having the big potential you guys found.
I think there's 3 takeaways to this, and one is where the game-changing ideas could come from. Again, so we screened for it. We looked as a team, we said, are there any fields today that have at least as high as an idea multiplier as the computer and telecom industry had it around 1990? And that was important because that was 5 years ahead of the commercialization, like the build out of the internet. The internet was around long before that. They actually see that in company revenues and the stock market. So we actually found as many as 5, which shocked me. One was you're seeing things around materials. I think particularly has to do with battery technology, but there's things around polymers and carbon fiber. I don't know exactly what that means. I think battery, though, it's particularly a highly charged state. That's where the multiplier is picking up. Transportation and energy, I think this is related somewhat to sustainability. We probe down deeper. It's a lot of ideas in the engineering field. And again, remember, just for your readers, these are ideas in the research lab. They're in the medical laboratory. They may be at a university or a company lab. These have not been commercialized. So by definition, they're going to be leading over the actual economy. These are products. They may be in patent form, but they haven't been commercially operationalized. That's the signals we're picking up. So it's tough to know exactly how it's going to play out, but we can tell the high energy state in these fields because of the citations going. There's something there around energy. The third big one is particularly around healthcare. And if I had to just pick one field and say, if there's something that's going to be bigger than the internet, what is it? It tends to focus on genetics, where the ideal multiplier, the overall one, has jumped from 200 to 400 to 1. That's well over 3,000. I mean, it is, and I don't know exactly what that means over the next 5 or 10 years, but genetics and genome research starting to show some applications, other part of the healthcare delivery system. So again, I'm not a medical doctor. I don't know exactly what that means, but that field is ripe for additional new product services or something's going to happen there, which is actually kind of exciting. The funny thing is, when I mentioned that, Meb, I said this at a recent conference. I said the irony is I didn't say the field of AI, and I didn't see machine learning or big data. Now, the irony is I think that's where one of the reasons this idea multiplier is jumping, those are the sort of what I call building block technologies, AI, machine learning, big data, they're smashing together that are starting to lead to new insights in, say, genetics research, or in energy research, or, I don't know, new material creation on a computer simulation. So it's not that those technologies aren't valuable, but it was funny to me when I started seeing the fields that some of these industries sound like value companies today, or the value sector, which I wasn't looking for either. So I said, maybe, I think it has a shot at happening, is that the irony would be is that if we have a genuine pickup in growth that's driven by, let's call it technology, at the end of the day, it always is. But let's say it's picked up by technology. The irony is that could be actually a tailwind to the value factor, which has gotten absolutely decimated over the past 5 to 10 years. I don't know if that'll play out, but that's what I think would be ironic, is that this sort of technological disruption, which knee-jerk reaction, I associate with tech and growth, like growth companies. This says 2 things are coming. One, it says the value premium could very well come back, because this is where the technology could be most commercially applied, is in some spaces which may be more value-oriented. Secondly, it also means if I'm large cap companies, we've struggled with seeing a number of startups create. There's been some hand-wringing over that. This says that there's been a delay, but there could be more startups coming because more ideas mean more new companies. Not on a one-for-one basis, but it does have some leading predictability there. Anyway, that's it in a nutshell, and I encourage people to say it. But yeah, full disclosure, we did not know what we were going to find. We stumbled upon this. We got on this project because we were worrying about globalization and trade, and we started looking at, the funny thing is that the globalization, I think, is accelerating when we define globalization in its most powerful dimension, which is the exchange of knowledge or ideas between cities, between people and across countries. And that is accelerating, which I think is ironic what they were speaking at Davos a few weeks ago.
Yeah, well, you start to just get the just basic concept of everyone being connected and the concept of knowledge compounding, where it has sort of power law effects in my mind. And it would make sense that as the internet's coming online and so much of the developing world, simple knowledge share going on, that it would sort of lead to some of these conclusions. But it's wonderful because it's an optimistic outcome. How much of a bear was data collection on this project? Did the partners you guys worked with take care of a lot of that? Or was this sounds like the world's worst PhD project to me?
I have the pleasure of leading the investment strategy group here. We're ultimately a research group, and we're roughly 65 people globally. The whole 65 global team was not on this project. It was several of us, but we started that almost 2 summers ago. It was a lot of work, Meb. We didn't know exactly where we were going. We talked to the data provider, which is Clarivate, which is sort of library database. They were helpful with some web queries, but we're pretty comfortable looking at large data sets. Now, this is big. 2 billion data points is massive. You can't download it into Excel, no matter how many rows and columns it has. You can't handle that. But that's the irony. As I said, in fact, our whole research insight is in of itself a manifestation of what we're talking about. That was not possible without big data analytics and some of the cloud computing. That's why I said I'm not dismissive of these new technologies. In fact, they're key enablers to different insights in other industries. And if we are going to see a pickup in growth, it's got to be outside of one small part of the technology field. Like cloud computing, the spread out of that, we're in the early stages of that, and that's going to be positive, I suppose, for growth. But that's basis point effects. How you get percentage point effects is you start to see whole unlocking and the need for increasing in capital stock or completely new unmet needs met, new services, new products, new industries. And that's been, you talk to a lot of smart people, they're very pessimistic on global growth because they struggle to see that. And these are individuals I highly admire. But I've been of the camp that we're in a low growth environment and we were going to be in it, but it's not necessarily permanent because that assumes that commercial innovation never picks up. And that's where I disagree with like a Bob Gordon who says the best days of global growth and U.S. growth are well behind us. I respectfully, he's a legend in economic history, but I've also told Bob, I said, you're underestimating the cyclicality. We've been here 10 times as a country before, having very low rates of commercial innovation. I think we're in one of these periods where the economy is trying to adapt and figure out how to use these new technologies. So longer term, I'm more optimistic. And so I still believe in the next year to two, if there's a risk to the markets and the economy, it's on the downside. And longer term, I think the risk to the upside. I think the general narrative has been, quite frankly, just the opposite, that if there are risks in the next year or two, it's reflation, it's better than expected growth and markets and all good stuff. But that the longer out the horizon you look, the more pessimistic people become. Low rates, low growth, secular stagnation. And they point to Europe, they point to Japan, and they say, well, that's the future we have to look for. And then, of course, we're not helping matters when we have lower expected returns, right? I think what we're starting to find is that I'm at least asking the question, what if the risks in those horizons are exactly the opposite? That the near-term risks are a little bit on the downside, in part because so much is being priced into perfection. But longer term, maybe we're all a little too pessimistic. And maybe if our return projections are too low, I don't think it's so much for our handle on valuations, Meb. I think it's that the earnings growth themselves, like the true fundamentals, are underestimated. And now we don't get historical 3 or 4% real earnings growth, right? That maybe that we get the 5 or 6, and maybe that's what we have underestimated, which we kind of take as historical averages. Maybe that's if there is the positive surprise of the next 5 or 10 years. And I think if returns are much stronger in the next 5 or 10 years, it's going to be because of that. It's not going to be because of some sentiment and valuation further extension, I think it's going to be because of the fundamentals were better than expected.
Well, that's usually what drives it in the long run.
Yeah, in the long run.
You've also written a little bit about looking out to the future. A lot of people have the topic of the future of work and how this is very quickly starting to play out in real life in many industries of software eating the world, but automation, robotics, labor market. We're now at one of the lowest unemployment rates in the U.S. Talk to us a little bit about your piece on the future of work and general thoughts there.
Yeah, I mean, what we found is, I mean, you've heard the stories, and I think everyone has, that there's some estimates as much as 50% of the jobs, even today, current technology could be automated in the next 10 years. I mean, you talk about sobering, there's troubling, and then there's, well, what if we lived in that world? One study estimated several years ago, 70% of the jobs in China could be automated away. I mean, I don't think we're debating the Fed cutting rates or raising rates once, or if that's the world we're headed for, that whatever we're talking about the economics profession today, that's not the right one. It's that. We looked at it because it's a really important issue. What is the future of work? What we found, though, is that general conversation, those estimates are too bearish, they're too high, and there's a reason for it. Our research finds that most of those frameworks confuse a job with tasks, that ultimately it's important to look at how technology will impact all industries and jobs by looking at the task profile of every job. And we did that. We got data that looked at the time spent and the relative importance of all tasks for every occupation in the United States and how that's changed through time. And each one of those tasks, its intensity it's either a substitute or complement to computer technology, in effect. And by all that data crunching, what we're able to find is that for well more than half the occupations, there's going to be a significant change in time spent and the task emphasis on the jobs, but those jobs aren't going to go away. In fact, more jobs are more likely to evolve than they are to get automated away. So I think that's the biggest one. That's the good news. I mean, roughly 20% of the occupations we estimate there will be significant downward pressure on the number of jobs. And what are those industries? Those are industries that have very few critically important tasks, and the critically important tasks that they do have go in direct competition with technology. So, there's probably some professions that jump to mind, but the important contribution of our work and why we got to a little bit more optimistic conclusions, at least for the next decade, and I'll come to the challenge as well, but is because we were able to look at the actual task profile of all jobs. Most professions have anywhere from between 12 to 15 critically important tasks that they do day to day. So even if you automate one of those tasks, such as, accessing certain information or processing some information, that there's other critical components of anyone's job that actually could make them more efficient. Now, the challenge, I think, of companies, of the workforce and the workers is technology is changing so quickly, the ability to adapt. Our analytics show that most jobs have changed their task profile by 50% over the past decade. 50%. Think about 50% of one's job time has changed over the past 10 or 15 years. So it does say people are capable of change. It doesn't mean, though, it's not going to be uncomfortable. And it does mean that there's going to be an incredible amount of change in the type of skills that are rewarded over the next 5 or 10 years. So I think that's a challenge for workers, for companies. We're thinking through, what does the average task profile or job profile of a portfolio manager look like 10 years from now? Or a salesperson? We don't have all the full answers on that, but we're thinking about all of that as we go forward. So I think there was good news and challenges as well. I think what that led us to the conclusion 4 or 5 years ago when we did the study, Meb, was one of the several paradoxes that I believe will exist in this world. And the paradox is we will continue to see advances in automation and continue to see more headlines on automation. And yet the irony will be that we will continue to have job shortages. And that's because of the demographic profile of the world and the fact that most jobs are more changing rather than disappearing. For, again, roughly 60 to 70% of the occupations. For 20%, there will be significant downward pressure when we try to identify those occupations, not line by line, but at a high level going time. So we're not as Malthusian, I'd say, or pessimistic as I think we're trying to be techno-realists. Well, I don't think we're certainly not blindly optimistic. We identify some of the challenges ahead. And we also identify the three key skill areas that in most professions are going to be increase in value. We identify those skills in the paper and competencies. But we're not techno-pessimists that everyone's pretty much doomed to technology. It's just past profile of most jobs is not consistent with that.
So we can only hold you for a few more minutes. I want to ask a couple pretty quick questions, but I'd be really remiss if I went through this whole podcast and didn't get to ask you about a fun paper, because I say to a lot of the listeners that to really have perspective, you need to be, in many ways, a historian when it comes to investing. And so you wrote a fun paper on America's first great moderation. Not 10 years ago, not 20 years ago. What did you learn from that paper?
Yes, well, it's fun. That paper spun out of my dissertation when I was down at Duke. And I did my dissertation. What I did is I created effectively a high-frequency index, an annual index of the cyclical, effectively industrial production, of the cyclicality of the U.S. economy, going back all the way back before World War I, all the way back to right around the signing of the Constitution. So it's going way back to 1790s. And the funny thing is I was not a historian by trade. I got into that because I wanted to do simulations, and I thought the data was available. It turned out there's really, for those listeners, there's really no effectively GDP or GDP equivalents that are reliable before the early 20th century, before like the 1920s, 30s, and 40s. And so had I known how much effort that was to get into that, I would never have done it. But that data collection ever became my dissertation. And then one of that insights is when you were able to create new data, which is something I really tell researchers, if you can create a data set or get access to a data set, that by definition will give you new insights because no one else knows that. Whatever it yields, whether it's something you thought was going to happen or not. And so this data, one of the papers I did with a colleague several years ago is when we looked at the annual growth in the U.S. economy, the early U.S. economy, I'm talking over the 19th century, 1800s. It turns out that there was a 17-year period before the Civil War that had no recessions. And so I just think it's funny, not many people, thank you for at least citing that paper or talking about it, Meb. Most don't even know it exists, but I think it's funny today because I've stopped chuckling when I see the press reports saying, oh, we're in the longest U.S. expansion. I said, well, technically, we're not. And so so for those that think the stock market has got well more to go, and I think there's clearly a risk that we could wake up 6 years from now and we're still in recovery phase. And I got to be careful how I say that because I'm not just blindly immune to some of the downside risk, but yeah, I mean, nothing magical about an expansion dying just because of old age. And this says that even in our own history, the irony about this great moderation, that 17-year period when we had no recession, is that was a period when we had no central bank. We didn't have a Federal Reserve then. And it was a period when it was undergoing profound technological disruption. So you had the build out of the railroad, of the telegraph, and so forth. So again, history never repeats. There's some similarities with today. There's a lot of stuff that's different and a lot of things that could alter that trajectory, but it does say it is possible. The one thing that also a lot of times you also need luck, and what we talk about in that academic paper is that long expansion that was 17 years, and again, for context, we're in 11th year now? It would have ended at only 9 or 10 years. The economy was starting to slow down. There was overbuilding in some areas, but it was actually a lucky event that kind of kept the expansion got a second wind, and that was the discovery of gold in California, which effectively was a fancy way of saying the money supply increases dramatically. So even though we didn't have a central bank, the discovery of gold in California was effectively like a massive Fed rate cut, which also led to a significant increase in demand. So it was fortuitous that occurred right around 1850, 1849, and that gave a second wind to the expansion. I don't think that the Fed's recent rate cuts in 2019 were that powerful, nor will they intended to be. But it does say that expansions can go on. Let's put it this way. If we can get through the next 2 years, Meb, without a significant downturn, I would hope we can. Maybe that's when our idea multiplier, if we're right on that, kicks in, and that's the second leg. So you're the first time I'm talking publicly about that scenario. It's not my sort of baseline, because if I say that's my baseline, that we're only midway through the expansion, they're going to throw me out in the street. as being crazy. It sounds pretty crazy, but it is possible. I still think that's more of a just upside risk to the outlook. I think the equity market at some days seems to think that's already a foregone conclusion, but it is possible, and we do have historical precedent for it.
Well, good. We'll have to have you back on in a few years to see how this is playing out. So, question, you've completed some big research projects as you're looking out to the new decade. Anything burning, searing on your brain right now, or anything that you're working on that's particularly interesting or curious, or any unsolved questions you have at the front of your head?
I think the thing that we'll come back to again is, I think there's three. One is just always continuing to challenge or to improve and enhance our capital markets model sort of framework. I mean, I think we have a good framework, but you can always improve it, both the signals we use and how we process the data. So that's one, because our distributions, our predictability can impact, have conversations with clients and the advice we may give them. So that's why that in itself is important. I think secondly, down the line is still, again, 11 years since the GFC by some dates, and we have more debt in the world than we did 10, 11 years ago. So the high level of debt, and how do we play that? How do we get out of QE and yet still stuck with this high debt level? So that this sort of interplay of monetary and fiscal policy, that ties into debt, it ties into the negative rates and quantitative easing and what's the exit strategy, if there is one. That's sometimes a big mess to think through that, but we got to think through it even more than we have. And then something that a risk factor that we haven't been too concerned about, and that is, we'll always come back to it, and that is consumer inflation. Not just the asset allocation, but I think we've done a good job there. We've generally been on point, but that doesn't mean we should be complacent on it. So there are the three really big areas, I think, right now. I think the fourth one, too, is globalization. Coming back to the trade, though, is I think we're just stalling in terms of a trade perspective, globalization, and we'll still modestly improve over time, but that could be wrong. So what does a world we're going from globalization to regionalization, what does that really look like? And let's think through the second order effects, the second half of the chessboard. Maybe we've underestimated some things. So they're the topics that come to my mind right now, Meb, that we have to think about. We have to sharpen our pencil for sure.
Last question. We always ask people, what's been their most memorable investment? Is that AMZN you're talking about earlier? If it is, you got to come up with something else.
Yeah, well, most memorable investment for me, it was having the fortitude to both stay the course and then with my discretionary, effectively my savings account, increase exposure to equities in 2009. I've only made very few discretionary changes to my asset allocation over the past 10 or 15 years. That was one of them. It wasn't right before the turn. It was over the course of that whole year. But that in my mind, because, that was going right against the gut where it just seemed like every day there was something more negative on the economy. Yet at the same time, our math was saying, listen, unless the world ends, and there's a non-de minimis risk that it does economically, that the market is pricing in a pretty somber economic scenario. And so having the personal fortitude to not only maintain my equity allocation, but to tell clients that if anything you're going to do in this environment, I'm more inclined to take more risk, not take less. But that's me. I can't speak for you. But that was a memorable environment. It's a little bit kind of like the fog of war. The whole late 2008, 2009, trying to figure out what the heck TARP was and trying to talk about purchasing of assets. In one sense, it's receded part from memory, but I do remember our conversation with investors, and they were good conversations of trying to walk them through why our expected returns were at least at historical averages. And that's memorable because I was feeling the same tensions or fears that I think some investors had, being very open and honest with them, but also being able to draw on my experience of history, as well as the math and the quantitative, the sort of thing, the valuations. Hey, this is, to have that whole rich conversation, that was very memorable to me. It was unfortunate we had to go through a global financial crisis to have those conversations, but any one of the listeners, many of them, they experienced that same environment. I've always told investors they should really be applauded because it's those sort of periods that were rewarded for the long run returns we expect to have. But it was those were trying days. So that's my biggest memory.
It's so hard to think in those, how emotionally charged those years were back in 2008, 2009, to the younger cohort of investors who haven't been through that sort of market yet. It's hard to relate that in verbal recollections, but living through it's a different story. Joe, you've got a lot of writings, a lot of great ideas you're publishing. Where should listeners, what's the best place for them to keep up to date with all your thoughts?
I'm trying to be better at putting all of our team's research on LinkedIn. You can go to my LinkedIn profile or Vanguard's LinkedIn. I mean, clearly our website. We have portals for if you're an individual investor, if you're an advisor, that you can clearly go to. If you don't know where to go there on our website, I mean, on the retail website, just go on there. There's a click always on Press Room, where not only have our papers, but you have a lot of different sort of really important announcements from Vanguard. I go to our press room sometimes, but I'll try to put things that certainly topics that we touched upon today, Meb, I would be at least, in addition to that, putting it on my LinkedIn profile, and Vanguard would be putting on theirs as well.
Joe, thanks so much for joining us today.
No, thank you for having me. It's been a pleasure.
Hey, podcast listeners, we have an unbelievable show for you today. You will find yourself in the presence of a true investing Zen master. And by the end of the podcast, you will learn lessons not only about winning the investing game, but also the game of life. Many of you will know our guest from his interview with Jack Schwager in the New Market Wizards book. He's a longtime trader, trend follower, author, and founder of TrendStat. In today's episode, we're talking trend following and trading. We start with some of our guests' early trades, cutting his teeth on corn futures, and as a disciplined trend follower, going through hell before his silver futures trade was in the books for a nice gain. We discuss power laws and outliers, and his finding that it sometimes came down to a handful of trades that made the difference between profit and breaking even or even losing money for the year. We cover the critical concept of position sizing and why it has been a cornerstone of our guest trading systems over the years. We get into the mental side of investing, and as we wind down, our guest lets us into the virtues of trading multiple symbiotic strategies. Please enjoy this episode with Tom Basso. Tom, welcome to the show.
Hey, good to be here.
Tell our listeners, where in quarantine are you in the world?
I'm in a little town of about 15,000 people called Payson, Arizona, up at about 5,000 feet in the mountains of Arizona.
We dipped into Arizona on our trip, so we're on an 8-state tour with my wife and child in a Subaru. We're on the last leg, about to go home to Los Angeles. And as I mentioned to you, stopped in San Francisco and a lot of NorCal. There was a fire tornado, by the way. We passed through Tahoe and they said there's a huge warning. You may come across a fire tornado. And I said, let's just go back to Colorado. It seems so much safer. California feels like it's going to fall into the ocean. But you're getting ready to go to Colorado, right?
Yeah, I am. We're going to do some fly fishing, some golfing at the Broadmoor, fly fishing at the Broadmoor as well in their new camp that they built a few years ago. And then for the first time, my wife and I are going to go glamping, which is sort of a high-end tent experience where they bring gourmet food to you and you go hiking, and it sounds really rough.
I'm actually a big glamping proponent. And my wife and I, one of our first dates was at a little glamping place outside of Santa Barbara called El Cap Canyon. I thought it was pretty romantic, but I remember this moment where we're looking up at the stars and I had like a star app that would like show you where all the constellations are, because I can only pick out the Big Dipper and that's about it. And I just remember her staring at me, just being like, can you put the phone away? I was like, yeah, but look, there's Taurus, there's Libra. And she's like, yeah, but this isn't interaction. So she was early to the get off your device. All right, well, let's talk about fly fishing. So we've done a ton of this on this trip. So this, if you're watching this on YouTube, this picture in the back is from the Flat Tops Wilderness. So we've spent a lot of time. My two brothers are big fishermen. And I'll tell you a secret spot in Colorado that has certainly the largest river trout I've ever caught, just an enormous fish. Is there any sort of fishing in the mountains of Arizona? You got to go to New Mexico? You got to go to Colorado?
We actually are 40 minutes away from the mountain lakes up here to the east, Woods Canyon and Willow Springs. And they have some holdovers, but they actually stock the lakes once a week with huge tanks of fish from the fishery that's also up on the rim. And the temperature in the water is about 60 degrees, spring fed. just a sort of a dammed up gorge, several of them, to preserve water and give the wild animals something. We've got a huge ponderosa forest, and we've got bald eagles, and we've got all sorts of peregrines and osprey. And so I've seen aerial battles overhead where an osprey would hunt for fish and go down and get the fish, and it's in his talon. And a bald eagle will come by and start doing an aerial combat with him right over my head. I'm taking pictures. And the osprey, to get away from the bald eagle, drops the fish. Bald eagle goes into a dive, gets the fish in his talon before it hits the water, and flies away to feed his young. Unbelievable.
We saw a few bald eagles on this trip. I also was wandering down a creek by myself, listening to a podcast, as I would do while fly fishing. The problem with that is you don't really hear much in the way of nature and sounds. Popped up upon a mama moose and baby. Thankfully, it was across the river. Otherwise, moose can be a bit ornery. Well, I figure we'll talk about markets at some point. I'll send you my secret spot later.
Yeah, that lake behind you looks like prime fly fishing on top, maybe.
The funny part about this turning into fishing hour with Meb and Tom, the river was great because my son, who's 3, we went down the river and it's like you could catch anything on a fly, these little small brookies, but the lake was obviously the bigger trout. My wife, who I'd learned has never caught a fish in her entire life. She's like, look, I want to do the fly fishing, but I don't want to catch the fish. Like, I don't want to torture them. I was like, well, we can just cut off the hooks and they'll just like bite the flies, bite the yarn, and you can have fun doing it. We at least let her catch one to say she caught a fish and let it go. But now she'll just probably be barbless. Okay, anyway, let's rewind a few decades. You've been at this investing world for a long time. And there's a topic I want to jump onto, but I think it would be instructive first because it's a good lead in to talk about a few of your first trades. I read about some of these in Market Wizards as well as some other podcasts. But when you were particularly young, some of the trades involving corn and silver, and I'd love to kind of walk through those because it leads into something I really want to get into. Can you rewind as painful or as
if you go?
Yeah.
Yeah, when I first started, I had no clue what I was doing. And back in those days, there wasn't Globex and electronic trading. You had to call your broker. There weren't any really quote machines that you could look at live over the internet quotes. So I decided I'm going to do some futures trading. I had already sort of not mastered, but felt very comfortable trading stocks, and I'd made some money and I could split off some assets to trade futures. And I decided corn was a small enough contract and moved slowly enough that would be a good place to start. And I only had I think $2,000 in my account. So I tried to understand it and I got my indicators already. I was using point and figure charts by manual on pieces of paper. I bought the breakout, promptly lost $600 and had no clue how I lost $600. And I had to go in and understand the math and what the value of the face value of the contract is and what the big number value in front of the decimal point is with corn. And then I finally figured out, okay, I really don't need to be trading 3 or 4 contracts of corn. I need to be trading 1 and I need more capital. So that was a big lesson there. And I had to take a hiatus for a while and figure out what was going on. I finally figured it out and started trading a number of different things. The silver trade, I guess the famous silver trade everybody knows from New Market Wizards, was one where now I'm putting money into my futures account. I'm trading it. I'm now actually profitable. I've gone through 4 years of losing the first year, losing less the second year, losing less the third year, finally breaking even in the 4th year, in the 5th year making money. And somewhere along the way into the future from there, I end up with a signal for a silver contract. I'm up to 130,000 roughly in my portfolio in just futures. And boy, I'm going to be a disciplined trend follower and I'm going to buy that thing and I'm going to hold on for dear life no matter what happens. And it turns out that the hunts were trying to corner silver at that point. So everybody was buying silver futures. They were buying bullion silver. They were trying to just suck up all the supply in the world. And what happened is the exchange caught on and had an emergency meeting. And meanwhile, I'm there cornering the silver and it's going up and it's going up and it's going up. And it's more than doubled in the face value, and I have made so much money. And now my account is worth about $500,000 at that point. So I've gone from 130 to 500,000, and I'm having a hard time sleeping. I'm having a hard time doing anything except trying to call my broker every hour and bug him about where is silver now. And can't do anything about it because I keep moving my stops up, and son of a gun, it finally hits the top. Exchange changes the margins. No longer can the hunts corner the silver market using futures. They have to pay full margin for it. They don't have that money. They have to sell their contracts. Now we're going gap down every day. Boom, can't get out. But I'm nowhere near my stop, so I kind of don't care, but I'm losing thousands and tens of thousands of dollars a day. I finally end up stopped out at $250,000 value in my account. So outside looking in, if you didn't know the details of what I went through over that month or two, you might say, well, geez, Tom, that was a good trade. You went from 130 to 250. And I would say, yeah, but I went through hell to get there. It was really, really the mental anguish that I was suffering. And I thought, I got to deal with this a little better. And how could I do that? And that's where I really came up with my volatility control as a percent of equity. And what I realized is if I started with 3 or 4 or 5 contracts of silver, there's no need to hold that number of contracts for the rest of the trade. All you have to do is change your position size slightly throughout the trade, and you can keep your mental side a whole lot more even keeled. And that fed to all my TrendStat days with clients, keeping my performance more stable. We had a nice business, last a 28-year run. Didn't have to declare bankruptcy or anything like a lot of other market wizards did, and didn't have to shut down my firm for such poor performance that it ended up causing people to just have to close their accounts because there was no more money left. So when we closed it down, we had a market math partnership that was doing awesomely. We had 6 or 7 different strategies being traded inside one fund. I was the largest client of the fund personally. It was great, but it just got to the point where government regulations and accounting and everything, it just seemed like I wasn't having a whole lot of fun anymore. And I'm having a lot of fun in retirement.
Yeah, that's very clear. We talk to a lot of young, aspiring investors, and universally I say to them, look, managing money and the business of money management are not the same thing. I say, I spend half my day signing forms, talking to lawyers, reading legal, the SEC, I love you, all these sort of things, dealing with hiring and firing and payroll and insurance. Everyone thinks it's like the sexy part of watching the show Billions, but there's a lot of just old school business. You're one of the rarities, Tom, where you have so many people. It's like the Seinfeld episode, stay too long. It's like all my friends in investment banking, when they start out as analysts, so I'm just going to do a couple years. I'm going to work 100-hour weeks, and fast forward like 10, 20 years. And they're just like, I'm just going to do it till I make partner. I'm just going to do it until there's this carrot. There's always this carrot, but you seem to be happy trading your own account and fly fishing. So
I absolutely love trading my own account. I don't have any SEC looking over my shoulder with rules. I don't have to publish any track records. I don't have to even create a track record. I don't have to audit anything. I don't have to have people show up without being announced to go through my files.
You don't have to get your tweets approved.
Oh, no. I just say
By the end of this podcast, you're going to have convinced me to sell my company and to move on. So let's go back before I go down that route. So what's interesting about the first couple of these trades, which I want to hear you talk about, because 99% perhaps of individuals and professionals, and it may be 99.9%, when you talk about investing, when we do this podcast, when you go on CNBC, when you listen to Bloomberg, all that anyone wants to talk about is the sexy part. What do I buy and what do I sell? You had a great book, which I recently read, on position sizing. Successful traders size their positions. And you talk as one of the only inputs, being the buy and sell, might not even be the most impactful input. Let's hear you expand on that. I want to hear you talk about that, because to me, that's sort of like
mastery level of investing, everyone thinks it's, what should I buy? Is it gold right now? Should I short Tesla? But in reality, the other things are probably even more important.
I call it cocktail party investing. I like Tesla because I made a bunch of money last year, whatever. If broken down into the simplest chunks, I would say, in investing, in my mind, you've got to have a buy-sell engine, some indicator, some way of what are you going to buy and when are you going to buy it and all that. You got to be able to put your order in. That's one part of trading. That's the part that everybody loves to talk about and is always on the television, radios, podcasts, whatever. The second part of trading is a lot less glamorous. It's how much will you buy or sell? And that's the whole position sizing concept. And I think that when I've done studies, and the famous study that I did once was the random number generator I used to get into approximately, I think it was like an 8 or a 9 futures portfolio, 2 directions. It would trigger a signal up or down. So you'd either buy or sell. And then you would stop loss and trail your stop behind it by just a logical moving stop loss. So as the market moved your way, you just went ahead and tried to capture as much of that as reasonable, giving it room to do a little bit of noise. I found that when I ran every 1,000 cases, because every case, because of the random number generator, would come out different. You'd either buy or sell each day. As soon as you got out of a position, you rolled the dice again or flipped the coin that afternoon, and the next morning you went in on open. That was how the study was done. Every single 1,000 run sample that I did showed a slight propensity, slight meaning you wouldn't want to trade this way, but a slight propensity to make money. You don't even have a buy-sell indicator. It's a flip of the coin. So that kind of led me to believe, but I did have great position sizing in that study. And I tried to prove to me that if you don't have position sizing, your drawdowns are going to be bigger, your runs up will also be bigger, but your return to risk goes down. In every study I've ever done, your return to risk goes down. I think people focus so much on when the good times are rolling and just knocking it dead that they forget about the drawdown. Like in COVID just recently in March, you have one of the most severe and volatile periods in the entire history of trading. And you have to be able to deal with all markets, up markets, down markets, sideways markets. You got to have a plan. You got to have a strategy. And I think position sizing gets more into that area where you're dealing with the fact that the market does not stay stable. It doesn't stay just going up or just going down. When your conditions are constantly shifting, why can't your position sizes be shifting? If all of a sudden the risk is low, you can take on a bigger position. If the risk is high, take on a smaller position. That way you maintain the third area, and the more important of all of them of trading is the mental side. If you do not have, you as the trader can override your position sizing, override your buy-sell engine. I've heard all sorts of people do that. I've heard of professional CTAs, not going to name names, that have overridden their trading strategy during the COVID crash. Just because it was so insane, so volatile, they didn't trust even what they were doing. And that to me is a sad state of affairs as a trader, because now you're out there not knowing when you're going to get back in and how you're going to get back in and what markets are you going to get back in and what conditions have to exist so that now you can override your override and go back to trading. You get lost in a twilight zone of trading, and I hate to ever put myself into that position. So I traded during the whole crash of COVID. I've traded all the way up again. I've had the best single month of my life in March of 2020 with the downswing. There was so much movement, so much volatility that if you just jumped on the trend and rode it, you just made a ton of money. And then it turned around, went the other way, and we're up 50% now.
You touched on a couple really important points. I think it was not only CTAs, you even saw some of these massive indexes just say, hey, we're not going to rebalance. Who is it? Invesco got fined like $100 million in one fund because they just forgot to rebalance. So I always laugh when people talk about indexes where you mentioned there's a very real human element. And some of the biggest hedge funds in the world, again, I'm not going to name names, during the global financial crisis,
said, well, hey, we have this approach. And then wait, hold on, just kidding. We're doing something else. And you kind of scratch your head and say, that's the whole point. Literally, you're supposed to be preparing for these outliers. Otherwise, it doesn't even matter in normal times. Anyway, okay, so trend following, I think one of the really important properties you touched on when you're talking about this sort of random generator, that trend following, and oddly enough, trend following and market cap indexing sort of have as the Venn diagram. I mean, market cap indexing, you could very easily argue is a trend following strategy. Is this not guarantee, but almost a guarantee for owning something that is in a really long-term trend, the really big compounders where this trend lasts for not just weeks and months, but potentially even years? Maybe talk to me a little bit about the importance of that property and kind of gets into power laws of these massive, massive winners.
The best story I have on that was back when, I don't know what got into me, but we were up a trend stat one year in futures. I want to say it was like 8%. It wasn't a phenomenal year. We made money. It wasn't a bad year. And I decided to do an analysis of all of the trades we had done that year and just see from top to bottom, the best trade of the year, the worst trade of the year, just take a look from a distance and say, do I learn anything from this? Is there anything that pops out at me that I can improve my trading on? And much to my amazement, when we added everything up, it turns out that 2 trades that year made the difference between Trendstat being at 8% and Trendstat being at 0. There was 2 trades. One of them was Japanese yen. I can't even remember the other one, but they were so huge that they were the profit. The rest of the stuff, essentially, literally hundreds and thousands, in some cases, of trades, depending on what program you're talking about, literally were break even. There was all that work for nothing. 2 trades paid the way. The very next year, I decided that was so interesting the year before, I'm going to do it again. And this year, we had a little bit better year. There was something like 3 or 4 trades that paid all the way. Year after that was sort of a not too great year, single digit again. 1 trade was the difference between making a profit and breaking even. And I haven't done that analysis in quite some time, but what it told me is that outlier that you talk about, the one that is the black swan, the big move, if you capture that, that makes you so much money that it pays for literally hundreds of other trades that are small profits, small losses. There are a lot of activity that you're doing in trading, and you're buying and selling, and that's what traders think they do. But they all wash. It's just a lot of work to get nowhere. You want to get on board that one big one. Well, the lesson to be learned there is if you flip a coin, eventually you're going to be on that trend the right way. And if you just let it run and keep your stops reasonable distance away and not get lucky enough to not get stopped out, you're just going to trail that stop. And you might be in a position, I remember a Japanese yen position I was in a year and a half. And people think commodity trading is all this buying and selling, it's aggressive and it's speculative and it's dangerous. And I'm one of the most boring investors you've ever seen. I don't view futures as anything other than just a vehicle, and how you dial in the leverage and the diversification and your strategies and your position sizing make a world of difference in how you make it exciting or you make it boring. And I'm probably someplace in between. I don't think I'm completely boring. We had a good March and we've had a good month this month too. But I think you have to think through all that stuff. And I don't think a lot of traders do. It's all the buy and sell. They go on the broker platform and they got their little Donchian channel or the Keltner band or the Bollinger bands, or pick of any one of the 100+ indicators on Investopedia.com. Throw it up on your screen, and then when it crosses the line, you buy it. And when it crosses the line, you sell it. And you forget about everything else. And I think that's a very shallow way to look at trading.
I'll tell you a funny story. We had joked for many years about doing the old Wall Street Journal dart throwing contest, right? Which often used to beat the pros. And I said, once our firm gets big enough, we'll actually file for this as an ETF, really as a way to just poke most of the money management industry, saying, can you not even beat this dart throwing ETF? Because if you can't, what are you doing? I actually thought about it. I said, we'll do the dart throwing, but then we should overlay some sort of trend following exit on these stocks. And then it adds even a better element of performance. And then it's going to be really hard for them to beat. And we were actually going to file for it in Q1. And then Corona happened. I just felt the timing probably wasn't right to really incite people and say, maybe we'll do it later.
Add not only your stop loss stuff, but add your position sizing to it so that you balance all the positions. And I almost guarantee you'll end up beating the pros.
We have some good tickers, Monkey and Random, for that. So one day it may come out.
Oh, I can't wait.
Here's the funny thing is that if you think about, I feel like trend followers is this subset of the world that actually labels ourselves trend followers. But again, market cap weighting is trend following. You're just based on price. The bigger, it's a naive, but almost no market cap weighted Vanguard indexers, the Bogleheads, are going to identify as trend followers. In fact, if you talk about trend following, they pull their hair out and go crazy. But also VC and angel investors, there's a good paper that just came out recently that showed the distribution of venture capital, private equity, and stock returns. And the same thing applies to all of them, whereas this long tail of massive winners that determine essentially all of the returns. Now, the VCs and angel investors understand this. They say, hey, I'm going to invest in 50 companies. My one Uber, my one Zoom, the 100X, the 1000X is the outlier winner. Now, they have a naive sell methodology, which is the company just goes to zero, or they don't even care about the doubles or the evens.
They've bought a call on the 50 companies and one call pays off and the others go to zero.
But it's interesting how little Venn diagram overlap there is in the thinking behind, like all three of those groups, that's the driving force, the massive winner outliers. And your friends, Eric Crittenden wrote a paper on this, on the stock return distributions, later co-opted by a bunch of banks. Why do you think that the sort of narrative behind it doesn't jive across boundaries? I don't know any venture capitalists, angel investors, Vanguard Bogleheads that also philosophically, quote, believe in trend following. What do you think the break is there? Is there any sort of thoughts?
In this world of instant everything, I remember competing against some advisors back in the day that were doing, for instance, selling. What were they doing? They were holding high yielding currencies and selling low yielding currencies and picking up the differential. And they would make money month after month after month after month after month after month. And they were even a little leveraged because that way they could have a nice return. And besides, they were profitable every month. Why not? But of course, what happens in that type of strategy, and you can see it just as sure as we're sitting here talking to each other, is sooner or later that high yielding currency like an Irish punt or something in the days before the euro just devalues. And that's a leveraged part of your portfolio and you are long. You just got yourself bankrupt. And I'd be plugging along and I'd practically be saying to the guys at Trendstat, who are those guys? Like Butch Cassidy and the Sundance Kid. The guys are trying to catch up with Butch and Sundance and never let go. They just kept coming and coming. And I'm thinking, who are those guys? They make money every month. I'm a good trader. I'm doing everything I can, and I can't keep up with these guys. And of course, then I'm still in business for 28 years, and they're out selling software or something. I think that happens a lot with the index funds and even a lot of the mutual funds and all the TV shows. And everybody's worried about how you did this last month or this last week, or I got this stock, which went crazy. Isn't that great? And they don't think through like I do, for instance, my next 1,000 trades, my next 2,000 trades. That's what trading's all about to me. I've got to do another 1,000 trades to make sense of anything that I'm doing today. That'll give me a sample size that makes sense. And when you start doing that and you realize that markets are going to have their up and down moves, and I think that accounts for, in my mind, by my definition, around 25 to 30% of all of time is either up or down. And it's heavily weighted in the stock market to up. Out of the 25, 30, it's probably pushing, it's probably pushing more like 25% of the time up, perhaps 9, 10, 12% down. 7, something like that. And then the other 2/3 of the time I rate as a sideways market. You spend 2/3 of your time as a trader in a sideways market. And so things like trading ranges, little pivot points and swing trading and all that, day trading lately, it gets a lot of flash because people are making tons of money doing it. I mean, Tesla, Amazon, some of these moves inside of a day, if you can day trade it, you can make a lot of money. But they don't think through the fact that that's not the way the world always works. There's going to be down moves, there's going to be sideways. And I think when you take your next 1,000 trades, you take a little bit more strategic perspective, and then trend following makes a lot of sense.
A lot of it probably goes back to the fact that people, I think, with markets really gravitate towards having a high batting average. Short volatility strategies eventually blow up every 3 years. They're up every month, 1% or 2%. They have a Sharpe ratio of 3, and then they get nuked. I'm sure there's 0 that made it through 2020. We did an article that was pre-financial crisis warning about the option selling funds. And I think all of them were gone, with the exception of maybe one after the fact. But the same thing, I think, applies to kind of the carry trades you're referencing. People put a premium on certainty and consistency, but this trend following, which has a lower batting average, but a lot more grand slams, is a lot more robust over time.
Right. It is robust over time. And over my lifetime, it would be a guess, but I think I might have run 33% reliable over all the trades I've ever done trend following in my life. Somewhere in that ballpark. It might be 30, it might be 35. I haven't kept every trade and figured it out, but my estimate is every time I go into a trade, I tell myself I've got a 2/3 chance of losing on this trade. And part of the mental side is then, hey, if I've got a 2/3 chance of losing, I better watch my stop loss, make sure I set it properly, make sure my position sizing is right, because I got a 2/3 chance of losing. And that kind of positions my mind in the right place.
How many trades do you think you've placed over your lifetime? Broad guess.
Oh, gosh.
Over, under.
Oh, my gosh. Well, it would certainly be tens of thousands.
Wow.
Have I hit 100? I don't know.
You better step up your game.
28 years in the business, probably would be pretty far from 100,000. I'm probably up in I'd guess 50,000 range maybe or something. Well, I often tell new traders that when you get to your 50,000th trade, believe me, it's as easy as breathing. That's about right. I mean, it's just another trade in a very large sample size. So it's just goes with the territory. Gray hairs and thinning hair.
It's a challenge, I think, for people to detach the emotions from any one trade. And I think with practice, perhaps, you mentioned doing tens of thousands, it becomes more of a Zen detachment. But that's hard. I think for some people, certainly automating it, going back to the certainty, one of the exits, if you want a trading system that has it's like a 99% win rate, is put on a trade, it could be even random, exit on the first profitable close. So most of the time it's the next day, then it's not, it's the next day, but then you just hold it forever. You're never exiting. But it's a terrible distribution. You have all these tiny, and then all these massive losers. It's like the inverse of a true trend following system. But most people would probably be attracted to that.
Novices will trade that way, actually, or something similar to that.
I talked about this on the podcast on one of the benefits, and I've changed my mind over the years, on the private investing side and kind of with the angel investing, is that it's almost a force function. It makes you become a trend follower because you cannot sell the investment. It's like the old coffee can portfolio, except there is no sell criteria. So only way that you end up exiting is if this stock or investment goes 10, 100x, because otherwise there's no liquidity. And so it's like a way of forcing people to become trend followers. That's almost like a modern hack that I don't know that most people, I think, in their head, if they saw an investment that doubles my entire 20s and 30s, I probably would have sold that. Oh my God, that's the best thing ever. This investment just doubled. But in many cases, you're selling that before a triple, quadruple, potential 10xer.
Yeah, exactly. And then the other thing you got going is the drawdowns. in things like more the commodity side of the industry or even the equity side of the industry. You go through a bear market in whatever, your equity drops. People say they can tolerate 10 or 20% drawdowns, but they really can't. I did a study once that's on the website that says that even professional allocators that would hire me as a commodity trading advisor and the rest of the top 30 trading advisors when I was in my heyday back in the 90s and 2000s, when you looked at money flowing in and out of the industry, it always flew in at the top of the equity curves when people had made a bunch of money, and it always flowed out right at the bottom of the equity curves after a drawdown. And investors enjoyed a worse track record than the commodity trading advisors had created with their NFA, National Futures Association, approved and audited track records. The actual client monies actually enjoyed a lower return. Why? Because of when they put the money in and when they took it back out again, not because the CTAs were doing anything bad. And I think that back in the day, I actually considered and talked to my buddies at Trendstat, my fellow people at Trendstat, do we want to do some kind of a fund with a lockup of some sort where we force people to stay for 3-4 years? This consensus was you'd never be able to sell it because people like the liquidity. But liquidity is sort of like handing dynamite to a 9-year-old kid or something. It's dangerous because of the client's inability to actually be a good client. One of the first books I wrote was Panic Proof Investing. The story behind that is I was so frustrated at my own clients pulling money out at the bottom of a drawdown, giving me money at the top of a surge. I wrote Panic Proof Investing, and I forced everybody to get a copy of that when they signed up with me. Did they read it? Probably not. Whatever. I tried to make my clients better clients because what they do affects what I do. I have to operate within the extreme fighting cage that they put me in. If they let me have the universe and I can do anything I want, I can go anywhere I want, I can use any trick I want. In some case, government regulation limits what you can do as a money manager, and certainly you know that. It limits what you say, it limits what you can do. Certain instruments you can't touch unless you've somehow figured out a way to get that past the certain Investment Company Act laws and other things. You get it down to this, okay, here's the rules I got to operate. I've got my right arm behind my back and I can't use my left 2 fingers. And now I've got to try to make these people money. It gets a little bit more difficult. And, that one of the reasons why I'm having so much fun in retirement is I'm my client. I'm not going to sue me.
You wrote an influential paper, at least to me early on, about investing during drawdowns. And over the last 10, 20 years, I've consistently seen, and this isn't just individuals, institutions too. There's a study I love to cite that said something like it was 95% of institutions, and this is real money institutions like hundreds of billions, trillions of dollars in AUM, how long they would tolerate a manager underperforming before they fired them. And it was 95% said 3 years or less. And it's the exact opposite of what it should be, which is you establish a manager or strategy that you would actually want to be allocating more. And it's the same thing with stocks as far as valuations. Going back to the old quote I attributed to Mark Yusko that says, investing is the only business that when things go on sale, everyone runs out of the store. So having a strategy theoretically that you should like it a lot more when it's going through the hard times. But people, they think the opposite. They chase performance, and it's a consistent detriment to what they're trying to do. And it's hard to try to make it systematic and educate people against it, because I think it just goes against their normal human nature.
It goes against human nature, and that's why a lot of investors fail. It's why guys like me and Eric Crittenden at Standpoint and others out there have figured out investing is a mental game more than it is having the perfect indicator or having even the perfect position sizing. It's a mental game to come up with a robust strategy that makes money in various conditions, loses money in other conditions, and for you to understand when those conditions exist. And I always tell traders, if you're in the middle of a drawdown, you've done your simulations, and let's say you're down 10%, and your simulation so that this strategy during these types of conditions would be down 20%, then it sure isn't broke. Don't start fixing it. I mean, this is normal. Ed Sequoia, who's a famous trader from way back, one of the first automated traders actually, he often said trading is like breathing in and breathing out. Breathing in is like profitable and breathing out is like losing money. You can't live without breathing in and out. And that's the way trading is. You can't trade without having profits and some losses. And the job is to try to make the profits be more than the losses are. And over time, you do fine. But people have a hard time with that. I think a lot of people say a good day for a trader is when he makes money. I say a good day for a trader is when he follows his trading plan. It has nothing to do whether he made money or not. The markets are going to do what the markets are going to do. I am way too small to dominate the market. Even George Soros and those types of guys are too small to dominate the market. The market's going to do what the market's going to do. And that's another famous saying I say over there. My wife quotes it now. The market will do what the market will do. If it goes up and you're long, you're going to have a profitable day. If it goes down that day, you're going to have a negative day. But you did what you were supposed to do. That's the important thing about trading. You got to come up with a plan and execute the plan.
We tried to illustrate some of what you were talking about with losing money and drawdowns to the buy and hold crowd, where I said, look, if you look at any historical asset, stocks, bonds, gold, there's only two states. It's all-time high or drawdown, and that's it. So there's nothing else. You're either in some form of drawdown or in an all-time high. And the fact is most markets spend most of their time being in a drawdown, just kind of by definition. And then I walked through a simple example where I said, most people are, I think Jerry Parker says this, are fearful with gains and hopeful with losses. And I said, well, think of the dumbest investing strategy, just only investing in markets when they hit all-time highs. Otherwise, you're sitting in cash. And as naive as that is, it turns out to be an incredible trend following strategy. You only trade, like the average trade it's like the longest possible one. And it's not the optimal. You do like a 12-month look back, probably better. But just to be an illustration, because most people, they hate investing at all-time highs. Anyway, the thing we always say is about having an investing plan and trying to write in all the possibilities. So what you talk about, a lot of that can be accomplished with rebalancing. Say, look, I'm going to do 30% trend following, 30% stocks, 30% bonds, and rebalancing. That has a natural sort of reallocation, mean reversion. And we had on two of the all-time great investors, Rob Arnott and Howard Marks, both talked about it using different words. Rob called it over-rebalancing. So when something gets totally nuked, instead of rebalancing directly to target, maybe allocate more. And Howard called it calibrating. But everyone, all the masters seem to arrive at this same sort of concept, which takes advantage of the people that don't use it.
The study I did on rebalancing was clear. If there's a cost of almost nothing, I mean, Schwab and others have gone to zero commissions now. So you got the bid-ask spread as your cost, maybe, very, very small. And if you were to take, say, if you were a novice investor and you just took 10 sector funds, ETFs, let's say you have $100,000 and put 10,000 in each, and you just bought and held them over time. And then what you did is at the end of every month, you take your total amount of equity, divide it by 10, and put that much in each of the 10. Just keep rebalancing it. Your return to risk will go up over time. I've done the study over and over again with lots of different strategies, lots of different markets. It's all dependent on the cost of rebalancing. If you were in load funds, for instance, and you had to pay like a 5 or 10% fee to rebalance, then that wouldn't be a good idea because the cost of the rebalancing would not equal the benefit that you take on. But if you have zero costs, rebalance every day. In TrendStat, we had 8 different strategies, and those computers would go in and take magic equity that we knew we had the total fund equity that we had to deal with, and we had the allocation to each. All we did for all the new trades that day was to rebalance that new equity across all the strategies. We did it every day. There was no cost to that, so why not do it? And it improved the return to risk ratio.
How has your approach changed over the past 30 years, either philosophically or practically? What have been some of the differences?
Well, one of the profound things that I think in the last decade, I'd say that I've really come to appreciate, and it's due to a friend of mine, Lawrence Bensdorp, who wrote a book called, it just came out, I think this year, maybe January, Automating Stock Trading Strategies, I think it is. And it sells on Kindle at Amazon, and you can get hard copies if you want and stuff. But he's a guy that heard me speak back in the Tharp conference days back in the 80s, when I would help out Dr. Tharp, who's an investment psychologist, a really good trading coach. He actually listened to me talk. He listened about position sizes and really took a lot of what I said to heart and really worked on his own mental side heavily. And he's become a spectacularly successful investor for himself. And one of the things that book just nails so perfectly in my mind and matches what my last decade or so of work has been in retirement is to, instead of trying to come up with one single way that's perfect to trade, that captures always every move that you want and eliminates every move that you don't want, why not look at different types of conditions? Perhaps a simple example, up markets. Well, you want to be long stocks in an up market. So let's say you do that with part of your portfolio. And then you develop a second strategy that is a short only strategy that only gets put on when you want to hedge the long stock portfolio. So maybe the short strategy trades SPY ETFs, or maybe it trades ES futures, which is the E-minis on the Standard & Poor's 500, or NASDAQ's NQs. And what you've got then is two strategies that are very symbiotic. They're going to help each other at times. When the market is going crazy upward, we'll call it, with my hand facing upward, making money this way, losing money that way. When you're doing that and there's no hedge involved, because the trend following short strategy, if it's an up market, is not going to have a position. So now it's sitting in cash and you're just making money over here. When the thing goes the other way, at some point you're going to get a sell signal. Now this hand, the hedge comes on, that's going to be fighting the other one. They are going to be symbiotically fighting each other, and essentially now your risk is much lower. If you have a COVID 35% down, you're going to lose a little bit maybe, but you're going to be hedged for a lot of it. I've made, I think, 20 something percent on my hedges on my stock portfolios in March, and that offset a whole lot of potential loss that I might have had over in the ETF portfolio or equities or whatever. And I think that you can take that to an even a greater extreme by, let's say, taking equities and overlaying futures like Standpoint has done, for instance, and like I do with my personal portfolio. You can do a lot of other things, add in shorter term timeframes, longer term timeframes, intermediate term timeframes, different markets, different countries. When you start doing that, all these different multiple strategies are exploiting a certain part of trading that you want to exploit. And when you start adding them all together, they become the pistons of an engine. If you ever see a cutaway of a car engine and how one piston's going up and the other piston's going down, but they're all moving the car, right? They're doing their thing, going up and down, but they're propelling the car in the right direction. That's what happens when you do that with your portfolio. And with automated platforms becoming a little bit more available than they used to be, or certainly I wasn't born with a knowledge of programming, so it's a learnable skill. You can go out and do some things to help yourself leverage your time, exploit different types of markets, and not kill yourself doing it. And I think that gives you multiple strategies as a way to go that helps, I think, traders be able to exploit situations without trying to design this perfect thing that's one thing that's going to always be right all the time. I think that's chasing a holy grail that doesn't exist.
Yeah, I mean, it's interesting because so many portfolios we see, not just individual, but institutions too, they look like they might be diversified, but when you kind of get down to the core, they almost universally are just so overweight some particular risk. Now, it may be a risk of inflation. It may be a risk, the one we see the most is just, it's all stocks, right? And traditionally in the US, it's all stocks in the US. And those sort of exposures often get exposed during periods like this year or other years.
2000, 2008.
And so diversifying across assets, but also strategies. And it's always strange to me on the trend following side that if you were just to put the strategies on a piece of paper and blind them and try to put them together in a way where people had to be honest but didn't know what they were, they almost universally end up with A, a chunk at all, which most don't have, but B, a very large chunk in trend following type of strategies. But it ends up when it gets implementation, the brain starts to short circuit or something. And if you take this a step further, it even applies to, I think, human capital sort of ideas. When people have risks, so many times throughout history, we see people investing in their 401ks in their own company's stock and just quintupling down on one very specific risk, Enron and others as well. But the beauty of what you're talking about, I think, is a much more thoughtful way of maybe not optimizing the exact return, but optimizing survivability, which is the most important thing.
Especially in retirement like me.
Yeah. You don't seem that retired to me. You seem pretty active.
Well, yeah, my friends say I'm the busiest retired guy they've ever met, but I'm having a lot of fun. I mean, it's fun talking to you. It's fun when I'm done talking to you. My wife and I are going to go hit some balls at the golf course. I'm going to finish up my packing this afternoon. That's all having fun. I'll cook dinner tonight or we'll go out to dinner. Life's good.
Let's touch on a few of those. It reminded me, as you were talking about Butch Cassidy, is we had stopped at a place the Hole in the Wall gang used to hide out in Wyoming as a famous fishing spot near Casey, Wyoming. Beautiful country. You write a website where you talk about a lot of your adventures and ideas, enjoying the ride, I believe at .world. Tell me about some of the focus. What are some of the main topics? You've touched on a few.
Mostly trading, and it all came about. My wife and I were having a glass of Rosado at the pool in Malaga, Spain on a vacation, going over and visiting a friend. And I was relaying to her this problem that because I've been retired a lot of years, I'm fair game for people that know me from New Market Wizards or interviews that I've done over the years to ask me trading questions. So I'm a new trader and here's an email and I've got this problem and how do I solve it? And I've answered thousands of these emails. And I said, it seems like I do this more and more people realize they can ask me these questions. I don't mind answering the question, but I kind of get a little bored answering the same question over and over again with the same exact words. And I was at that point trying to figure out a way I could automate this a little more. So I could, okay, that's a question on buy-sell engines. So what I'm going to do is have this standard thing that I'm going to attach to the email, send it back, save myself a lot of time. And we kicked it around and then she said, well, you're retired. Maybe you could do Zoom calls or some kind of group calls and help people that way. And I said, yeah, but then I got to schedule that. Then I'm working again. I don't want to work again. I'm enjoying retirement. So we came upon the concept of synchronous versus non-synchronous. You and I have to be on this call at the same time so that we can talk to each other. But the emails that set it up were all asynchronous. Somebody in your operation sent me an email, and when I could get around to it, I sent a response. That's the kind of thing that you could do in retirement and then not have to be tied down. So I said, well, how about a website? And she said, well, yeah, and you always end all your tweets with enjoy the ride. Why don't we get enjoytheride.com? Well, it turns out enjoytheride.com was taken, but enjoytheride.world was not taken. And I thought, I've got people sending me emails from all around the world. That's perfect. So I grabbed that URL and it took a year to design the website, but with various people helping. And it cost me probably 5, 6, 7,000, something like that. But what I tried to do there is make it a retirement website for me. It takes all my knowledge of trading, all my recommended reading. People ask me, what book should I read? Well, you got a whole list. Just hit the reading tab. If you want to get a video about what I think you have to do to create your own personalized trading strategy, I did a 16 video series on that. That's in the store. There's the book you mentioned on the position sizing. You can get an electronic copy there. There's research. All the research papers I have ever produced in my life are all in one place. My entire hedging strategy explained in gory detail is another tab. So all these questions that I get from people on various things, I've just tried to stick them on the website, and it has actually cut down slightly on the amount of emails I get. I do get a few, and they're usually a little bit more interesting emails. They're asking me a question that's really difficult to answer, and it challenges my brain. I love those. I've also been able to help a lot of people just thousands. I mean, I've got thousands of users. I've got 4, 5, 6,000 traders show up on the website every month. The website pays for itself by way of the stupid little things we sell at the store. It's a way of just giving back to the industry without me having to be sitting answering emails all day long over and over again saying the same things. So it's been fun.
We'll post a link in the show notes. You talk about cooking on there. What's your go-to? Do you have a favorite recipe?
I got an O on the end of my name. It's Basso, Basso, so which is the bass voice in the choir, by the way. Basso voice. My wife has this charming thing she says to people. When Tom gets in the kitchen and tries to cook something, it starts out as maybe Asian or French or whatever. And by the time he's done, it's sort of Mediterranean. That's probably true. That's probably my sweet spot, is the flavors of sage and rosemary and basil and tomatoes and cheeses and those types of things, veggies. I like al dente veggies. I love seafood. I love chicken, steak, all the meats. I actually like more of the exotic stuff too, the bisons, the elk. I love rabbit. I've done a lot of great rabbit dishes. Those are fun. So that's kind of where I go. I try to do different things. I cook something that she likes. She says, this is a company dish. And I say, well, I'll never make it again exactly that same way, because I just sort of taste things and make it up.
If you haven't heard this, stop me if you have. Listeners have many times. They're probably sick of me talking about this, but I had gone through an experiment. Being a quant, a rules guy, I said, theoretically, most recipes are essentially rules. If you and I had a recipe, broadly speaking, we could follow it, come out to near the same result. Now, I'm not talking about the art side, if you're doing foams and gels or like pure masterpieces, but just the big fat part of the distribution. And I said, there's all these recipe websites. Half of them don't have ratings. The ones that do, you can't sort them. You can't manipulate them. So I found a guy in Poland on one of these websites where you can hire developers. I said, I want you to scrape the top 10 recipe websites and pull it into a database for me. They said, sure. Like, what's your budget? I said, God, that would take me like a week. I was like, I don't know, $500. And within like an hour, he had done it. And I said, oh man, I should have said like $50. Anyway, I got a database, New York Times, food.com, all these, and then was able to sort them with the theory that the 5-star rated recipes with 10,000 plus reviews would be universally better than the ones with 2 stars, and did a fun experiment. We were going to call it the Quant Cookbook, where I was going to go through and cook all these. And we did about the first 5 or 10. Interesting takeaway was it was a lot of like crowd pleasers. It's like the world's best lasagna, or gooey chocolate chip cookies, which I love, but I think I would be 50 pounds heavier in quarantine for most of these. But I'll send you the link. It's for a fellow quant may appreciate some of the outcomes.
Yeah, recipes are nothing more than a guideline to me, and I create my own.
Yeah, I love it. Tom, if you look back over the career, you mentioned a few, but we always ask people what's been their most memorable investment. One of the ones you mentioned, something else come to mind, good, bad, in between?
Memorable investment. There's been only tens of thousands.
Of the 50,000, you got to pick one.
I guess getting involved in a small company in Phoenix here, which ended up becoming the largest supply or distributor of bulk cream. If you ever go into a quick store or like a 7-Eleven, those types of things, you go get a coffee and you see this gray looking cream dispenser that you can put half and half or cream or flavored creams and things into your coffee. That was produced by a company called Cream Miser. I was the largest shareholder of it.
How'd you find that? Just local due diligence?
It was local. Somebody needed private equity. I ended up investing in it. I invested in it again when it was about to go bankrupt. And then I kept it from bankruptcy a third time, served on the board for a lot of years, and was there at the end when I think it was Dean Foods came in and bought us out. That ended up being a pretty good role.
Is a natural hedge to your trend following. There's a value investor in there somewhere, Tom.
Well, I knew that the bulk cream was so much cheaper to produce and to get out to the public. So if you're a 7-Eleven and you do those little tiny, those little cream things, and you grab 2 or 3 of them, and they actually did studies at Creamizer, which were humorous, where we had one-way mirrors, and we'd watch people sticking a whole handful in their purse, and guys would put them in their pockets, and people were only pouring half of it, and then they'd leave a mess all over the counter, and clerk has to go over and do something with the mess. We just show a video to people about what really happens with the way that they're doing their cream. And all of a sudden, everybody wanted our bulk cream dispensing. So we ended up with over 90% market share in bulk cream dispensing. It was a fun little project. We had a lot of brushes with bankruptcy as we were trying to muddle through what every business goes through, getting off the ground and finding injection molding people to do those refrigerated cases, and backup suppliers from Brazil to get the refrigeration units, and all sorts of other stuff that was not related to trading at all, but taught me a lot about business.
Agony and ecstasy of being an entrepreneur. It's too much work. I wouldn't wish it upon anyone, but so much fun. Tom, we'll post a link to the show notes, your website, and everywhere else. It's been so much fun. Would love to keep you all day, but you got some golf balls to go slap around. Thanks for joining us today.
Hey, thanks, Meb.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. My current favorite is Breaker. Thanks for listening, friends, and good investing.